Hello, and welcome to Session 9 Quiz Review. Today we're going to take a look at just a couple of frequently missed questions along with the mini problem we did for this quiz. We'll start with number 4. Number 4 says, money or property given to the following is deductible as charitable contributions except A, nonprofit schools or hospitals, B, civic leagues and chambers of commerce, C, churches, synagogues, temples, mosques, and other religious organizations, and D, war veterans groups. Well, the correct answer is B. Civic leagues and chambers of commerce, charitable contributions you give to them would not be deductible on Schedule A. And as you can see here, there's a nice table in IRS Pub 17 on page 162, Table 24-1, and I've brought up Table 24-1. It gives you examples of organizations that are and then are not deductible. What you need to do when you're working with your tax client is to look for their receipts for their charitable contributions, make sure that it says they're a 501(c) charitable organization on the receipt. If they're not, the IRS does have a publication online where you can look up if an organization is registered as a 501(c)(3). Here, let's go on to number 5. How is an appraisal fee you pay to determine the fair market value of an item you donate to charity deducted? Well, the IRS does insist that you require that you get an appraisal fee on any non-cash donation that's $5,000 or more. Now, normally you will have to pay for an appraisal like that. It is not allowed to be added to the basis of the donation or to the fair market value of the donation. The IRS allows it to be a deduction on Schedule A, line 23, and it is subject to the 2% of adjusted gross income limit. And we will learn more about those as we go through the next several sessions. Go down to the mini problem. Here we have Donald Duck, and he had a number of different expenses for 2012, and what we've asked you to do is to fill out his Schedule A and decide which expenses are going to be deductible on Schedule A and which are not. So the first one, and most of the time this one's pretty obvious, is pre-tax medical insurance premiums. You've already received a tax benefit from those because you've been able to have those withdrawn before you have taxes withheld on your wages at work. So what we have left, we've got prescription co-pays, reading glasses, dental visits. All of those are eligible expenses for medical expenses on Schedule A. They add up to $750. You can see that we've put them on line 1 over here on Schedule A. Now, the one thing with medical expenses is they are limited to anything above and beyond 7.5% of your adjusted gross income. We've told you Donald's adjusted gross income for the year is $75,000. So if you multiply that by 7.5%, you get $5,625. And as we can see, his $750, even though that is a lot of medical expenses, they still don't meet the minimum amount. It would have to be anything that's above and beyond $5,625. The next line on Schedule A, income taxes. You can see that Donald had $6,000 in state withholding, plus Donald made estimated tax payments during the year that totaled $1,900. Both of those items are an eligible deduction on Schedule A, and we've entered the amount of $7,900 on line 5. Next, we told you he had property taxes that he paid of $4,000. So those go on line 6 of the Schedule A. Bring down the total. Line 9 for the taxes you paid is $11,900. So let's skip down here to home mortgage interest first. We told you Donald paid $15,000 in home mortgage interest. Is deductible on Schedule A. We've entered it on line 10. You can see it there, $15,000. And let's take a look at margin interest. This is where most people have a problem and get confused on this. Margin interest is deductible on Schedule A, but it is limited to the amount of investment income that you have. So let's take a look down here at what we told you, what Donald had for his investment income for the year. He had $400 of interest income and $400 in dividend income. So that's a total of $800 of investment income. So Donald's investment interest expense is limited to $800. And we've entered that on line 14, totaled out the interest that you paid for the year, line 15, $15,800. Now let's take a look at what Donald had for charitable contributions for the year. He gave used clothing to Goodwill. He gave cash to the church. He gave a used vehicle and 100 books to the public library. And then he gave cash to the Chamber of Commerce. We already covered in question 5 that the Chamber of Commerce does not qualify as a charitable contribution. The cash that he gave to the church is a direct entry on the line 16 for the $1,500. And then on line 17, we total up his non-cash donations and put them on line 17. Now, because Donald's non-cash donations were more than $500, we are going to have to fill out an 8283 for anything that was non-cash charitable contributions. You can see here in column 1, they're asking for the name and the address of the donor organization. We have put each one in its own separate line. Column B, if donated property was a vehicle, check this box. We have done that for the Volkswagen. And then there's a description of the property that needs to be put in column C. We've got used clothing, we've got 100 books, then we have the information concerning the vehicle. And the IRS has very specific items that they ask. You need to have the vehicle model, the year, and the mileage and what condition it's in. And you should be able to find all that information on the 1098-C that you are given from the charitable organization that took the car. Down here, we go ahead and put in the dates. We've got 5/2, the date of the contribution, 9/25 for the book. C, we've got the vehicle. So now we also, in column E, you need to put in the date they acquired. And when you have multiple items such as clothing, various is an acceptable term to put in that column. And then you need to designate how you received that asset that you're donating. Either you inherited it, or you purchased it, or it was a gift. And then you put in the donor's cost or adjusted basis. This would be, in the case of purchasing, how much money you spent on purchasing that item or items. So fair market value, that would be what it's appraised at now, or in the case of the car, what it sold for at auction. In close, we have $400. That's a thrift store value. Then we have comparable sales for the books. So if you went to a used bookstore, how much would you have spent on those 100 books? $2 a piece is what we're saying here. And then on the vehicle, that was sold by auction, so that is the amount that you're going to be using. That is the end of the quiz review for session 9. It's now time to go on to session 10. Welcome to session 10 of the basic tax course, Itemized Deductions, Unreimbursed Employee Expenses.
So let's just begin with a brief introduction. Miscellaneous itemized deductions generally relate to expenses that you incur as an employee or are related to other income production such as investment or hobby income. You can deduct expenses you incur to produce or collect income that must be included in your gross income, and to manage, conserve, or maintain property held for production of such income, or to determine or contest, pay, or claim a refund of any tax. You can deduct expenses you pay for the purposes of 1 and 2 above, only if they are reasonable and closely related to these purposes. The most common items that I see my clients claiming as miscellaneous itemized deductions include unreimbursed employee expenses for car, travel, meals, entertainment, and education, job search expenses, union dues, tax advice and preparation fees, safe deposit rental when the box contains investment property, hobby losses to the extent of hobby income, and gambling losses to the extent of gambling winnings. And although these are the most common ones that I see personally, there's plenty of others, and we're going to be discussing a lot of other deductions, not just those. When we're dealing with miscellaneous itemized deductions, in most cases we're also dealing with a 2% limitation. And while there are a few deductions that you are allowed to claim that are not reduced by 2% of your AGI, most of the types of deductions that you are able to claim typically are reduced by 2% of your AGI. I personally find that that 2% limit is restrictive enough that it prevents most people from claiming any deductions at all. And since most people are not able to claim miscellaneous itemized deductions because of the 2% limit, it stands to reason how many fewer people are ever able to claim a casualty or theft loss with a full 10% limit, or medical expenses with a 7.5% limit. So let's see what I mean by that statement. Your adjusted gross income, which is $40,000, not a terribly high number, good middle class income level, and easily an income level which a person could be incurring employee business expenses. And let's just suppose you're earning $40,000 a year, and during that year you incurred $600 of employee business expenses. You'd probably think that's a pretty high number, but it's not nearly enough to beat 2% of your adjusted gross income, because 2% of your AGI is $800, so ultimately the deduction is lost and you're not able to claim it. Unreimbursed employee business expenses. These are claimed on Schedule A, line 21, and we're actually going to be taking Schedule A for the miscellaneous expenses in line order. So the first items we're going to be talking about are items that fit on line 21. We'll then take a look at line 22 and then line 23, and after we're done with all of that, we'll take a look at line 28, which is not showing right now, but it is the line on which you claim deductions, not subject to the 2% limit. Now, in terms of employee business expenses, you can deduct only unreimbursed employee expenses that are paid or incurred during your tax year, that are paid for carrying on your trade or business of being an employee, and are ordinary and necessary. An expense is ordinary if it is common and accepted in your trade or business or profession. An expense is necessary if it is appropriate and helpful to your business, but an expense does not have to be required to be considered necessary. I have had an example that I've used for years. It's kind of a silly one, but it drives home a point. Right now, I am sitting at a desk in a chair. I could sit on the floor. So you could say that it's not insurmountable that I could operate without a desk and a chair, but it is considered ordinary and necessary for a person working in an office to have these items, and therefore they are clearly allowable expenses. You may be able to deduct the following items as unreimbursed employee expenses: business bad debt of an employee, business liability insurance premiums, damages paid to a former employer for breach of an employment contract, depreciation on a computer your employer requires you to use in your work, dues to a chamber of commerce if membership helps you do your job, dues to professional societies, educator expenses, home office or part of your home used regularly and exclusively for your work, job search expenses in your present occupation, laboratory breakage fees, legal fees related to your job, licensing and regulatory fees, malpractice insurance premiums, medical examinations required by an employer, occupational taxes, passport for a business trip, repayment of an income aid payment received under an employer's plan, research expenses of a college professor, rural mail carrier's vehicle expenses, subscriptions to professional journals and trade magazines related to your work, tools and supplies used in your work, travel, transportation, meals, entertainment, gifts, and local lodging related to your work, union dues and expenses, work clothes and uniforms if required and not suitable for everyday use, and finally, work-related education. Well, we're going to be taking a look at some of the most important of these items in quite a bit of detail today. And the ones that I'm talking about because they're the ones that the IRS scrutinizes really, really closely, and or there's complex rules surrounding them. So essentially, when you're claiming employee business expenses, you're probably upping your client's odds of an audit, and therefore being really on top of the rules is important. It's especially important, I think, because many clients think that they are totally justified in being able to claim that expense. They want to be able to claim it. They want you to put on the tax return. And the question going through your mind as the preparer is, okay, can I do that? And it isn't just a matter of proving the expense was ordinary and necessary. There's more tests that have to be applied than just that. to arrive at whether or not the deduction can be claimed. And we'll see what I mean by that as we get closer to the end of today's presentation when we get into discussions of accountable and non-accountable employer plans at work. But before we get into that, we're going to talk about the rules for each of the major types of deductions and what has to be applied in terms of determining what a deduction is. And with that, we're going to start with local transportation expenses. The IRS says that the cost of getting to and from work is generally not an allowable expense. However, certain local transportation costs can still be deductible. Local transportation costs include ordinary and necessary costs of all of the following: getting from one workplace to another in the course of your business or profession when you are traveling within your tax home, visiting clients or customers, going to a business meeting away from your regular workplace, getting from your home to a temporary workplace when you have one or more regular places of work. These temporary workplaces can be either within the area of your tax home or outside of that area. There's a little caution note here. Local business transportation does not include expenses you have while traveling away from home on business overnight. So what I'm talking about here is only local transportation in the vicinity of your tax home, because when you travel away from the vicinity of your tax home, you don't have local transportation, you have travel. And we're going to talk about travel separately. Right now we're just looking at how you go about claiming a deduction if your client has local transportation expenses. Temporary work location is a concept we have to look at, and a temporary work location is a location that lasts 1 year or less. You could kind of combine that concept with the concept of long-term versus short-term capital gain income. To be long-term for capital gains, you have to hold an asset longer than a year. And if you hold it 1 year or less, it's considered to be a short-term capital gain. The IRS has that same rationale when it's applying to temporary. Is the work location temporary or is it permanent? And it is considered to be permanent if it lasts more than a year. And it's considered to be temporary if it lasts 1 year or less. If you are assigned to a temporary work location in the local area of your tax home, you may be able to deduct transportation expenses subject to the following. If you have a regular job location and you commute to a temporary work location in the same trade or business, you can deduct the expenses of the daily round trip between your home and that temporary location. If you have no regular place of work, but you ordinarily work in the metropolitan area where you live, you can deduct daily transportation costs between home and a temporary work site outside that metropolitan area. So let's think a little bit about what we've got going on here and who might fit into this first category. You have a regular job and temporarily you have a new work location. Let's just suppose that you are working for your employer at a particular work location, and that employer decides to temporarily close that location for a period of 3 months while it goes through a remodel. And for that 3-month period, you are temporarily assigned to another work location. The fact that you are now temporarily assigned to another work location means that the commute from your home to that temporary location is actually deductible. But if that temporary location is expected to last 13 months, then none of it would be deductible because it's expected to last more than a year. So you first have to establish that it is a temporary location. If you establish that it's temporary and you normally have a regular location, then when you leave home and go to that temporary location, that is an allowable business expense. Let's look at example number 2 here. If you have no regular place of work but ordinarily work in the metropolitan area where you live, you can deduct daily transportation costs between a home and a temporary work site only if it is outside of the metropolitan area. Well, who comes to mind? Just those of you who are participating in the class live today, you could send me a chat. What kind of a worker do you think fits this second category? That you would probably see this worker come in and that worker would probably have a lot of driving expenses but not have a regular work location. Can you think of anything? Service repair people, that's an excellent one. Definitely. I can think of another one as well, which is a construction worker. So service repair people, they might have a regular work location. If they have like a home location that they go to, they drive from their home to the main service location and they get their job duties for the day, they're given their agenda, and then they drive from that work location to the first service call of the day. Definitely the drive from where they pick up that order at their main work location and the first service call of the day is going to be deductible. But if they were to drive from their home to that service location, that would be deductible too. So they really have to not have any place that they normally go or normally check in for work. And for me, a repair person could be it, but a more common one, the one I usually run across, is construction workers, because construction workers typically don't have a home base that they work from. A self-employed painter, their work location is their home office typically, so they do have a main work location. It's typically their home office. So we're looking at someone who doesn't have a home office and also doesn't have a regular work location. And the one that I run across most often is union workers who are working in construction. They basically go to the union hall, they get their work assignments, and then they travel to those work assignments. And if those work assignments are inside the metropolitan area, that is not going to be allowed as a travel expense or as a local transportation expense. So local transportation, when you're driving to and from work, that's called commute. Commute costs are the cost of driving to and from work within your metropolitan area. Commute expenses are never deductible, and the following transportation is considered to be commute. Driving to a temporary job site when you do not have a regular work location. If you do not have a regular job location, you cannot deduct daily transportation costs between your home and a temporary site within your metropolitan area. These are non-deductible commute expenses. So in order to have a temporary location inside your metropolitan area, you have to have a primary work location. If you have a primary work location, a work location you normally work at, and temporarily, even if it's just for a day or even 3 months or even 6 months, up to a year, you're going to a temporary work location, then you can deduct that commute between home and that temporary location. But if you don't have a temporary location and you're essentially all the time switching from various work locations around your metropolitan area, then none of those travel expenses are going to be allowed, or those transportation expenses are going to be allowed at all. But if you have one main work location, whether it's a fixed location or a varied location, and then you drive from that location to another work location, then you can deduct that. So from driving from home to a second job, you cannot deduct the cost of driving from home to a second job, but if you drive from one job to a second job, you can. And that's where we get into two places of work. The following rules apply if you work at 2 or more places in the same day. You can deduct the expenses of getting from one workplace to the other, but if for personal reasons you cannot go directly from one work location to the next work location, such as a detour to visit your doctor along the way, you can only claim expenses equivalent to what it would have cost you to travel directly from one work location to the next. Parking. Fees you pay to park your car at your place of business are non-deductible commuting expenses, but you can still deduct the cost of business-related parking expenses if you are visiting a client or customer, or you are attending a meeting that is away from your normal work location. The IRS summarizes all of these concepts in Publication 17 on page 184, where it has this image right here. So this is a straight copy and paste out of Pub 17. And these instructions up here also come from Pub 17. This is what Pub 17 has to say about its own illustration. We have your home, and we have a temporary work location. And the rule is that it is deductible to travel from your home to a temporary work location if you have a regular or main job at another location. And if you are traveling from your home to a second job, well, that's never going to be deductible. And if you're traveling from home to your regular main job, that also is never deductible. But if you're traveling from your regular main job to a second job, or from your regular job to a temporary location, that's always deductible. And if you drive from your second job to a temporary job, that also is always deductible. Deductible transportation, we have deductible local transportation, and we compare that in this table here to non-deductible local transportation. Deductible local transportation includes commuting from one job to another job in the same day. Non-deductible local transportation includes commuting to and from your job. Deductible includes fees for parking while attending a meeting away from your normal work location, but you can never deduct the cost of parking for just your regular work at your regular work location. So let's think about this a minute. Let's suppose you work downtown. Usually when you park downtown, you have to pay for a parkade, and that parkade can obviously easily run you a few $100s a month. And the IRS says if you are paying to park downtown so that you can go to work every day, that's going to be a non-deductible expense. Now, your employer is allowed to provide you with parking assistance. They can pay a certain amount of parking for you each month, but they are limited on the amount that they can pay for your parking. And if the employer pays more than the annual limit or the monthly limit for the parking, they have to bump the difference up in your wages and treat that as taxable income. But if you're paying for your own parking, you get no deduction at all if that parking is associated with your commute. Now it says you can claim the cost of putting an ad on your car as a business expense, but the fact that you have an advertisement on your car does not create a business use of the car, and you still have to calculate the business use of that vehicle separately, and we're going to talk about how we do that in a little bit. You can claim the cost of operating a for-profit carpool, which you operate as a business, but you cannot claim the cost of your share of carpool expenses that you pay to travel to and from work. And added costs that you pay because you haul tools or instruments to work are deductible, but the fact that you haul tools or instruments to and from work does not mean that you are using your car for business purposes. And finally, on this non-deductible local transportation, union member trips to a union hall are specifically disallowed as a business expense. So that's one that my tax clients who are employees of companies who get their work through union halls frequently ask if they can claim the cost of driving to the union hall to get their work assignment for the day, and the answer is no. You have two different methods that you can choose from. You can choose to claim the actual cost of operating your car, or you can claim a standard mileage allowance. Whichever method you choose, you do need to keep adequate records to prove your business use. You can claim the standard mileage allowance, and if you do, the standard mileage allowance for 2012 is 55.5 cents per mile. And for any assignments that you complete as part of our tax courses under 2012 law, of course, when you complete those assignments, you would need to use the rate in play for 2012. But since we are now in 2013, I've given you the rate for 13, and it's a penny higher. The following rules apply if you want to use the standard mileage rate. You can claim the standard rate instead of the following: depreciation, gas, insurance, lease payments, licenses, oil changes and other maintenance costs, registration fees, repairs, and tires. If you claimed actual expenses on a car that you leased rather than own, you cannot claim the standard mileage allowance in any year after a year where you claimed actual expenses. If you choose the standard rate, you cannot claim actual costs of operating your car in the same year, and even if you claim the standard mileage rate, you can still claim allowable costs for parking and tolls. You cannot claim the standard mileage rate if any of the following are true. You operate 5 or more cars at any time or at the same time for your business, because if you do, you are considered to be operating a fleet, or you claimed a depreciation deduction other than straight line for the car in an earlier year, or you claimed a Section 179 deduction for the car in an earlier year, or you are a rural mail carrier who received a qualified reimbursement, or you claimed actual expenses on a leased car. When claiming the standard mileage allowance, you will multiply the number of business miles driven by the standard mileage allowance. Even if you claim actual expenses, you must track the number of business miles you drive so that you can prorate your costs between business and personal use. Now, I have to say, when it comes to our tax clients, my tax clients, and their ability to keep a mileage log as they're supposed to, that skill is sorely lacking in most of my clients. It's always a big nightmare trying to help them through figuring the amount of mileage deduction they're allowed to claim, because so few of them actually keep a mileage log as they are supposed to. And sometimes they'll come and they'll present me with a mileage amount, and I'll say, okay, so this is your mileage for the year, and they'll say yes, and then I'll say, and what was the total number of miles you drove for the year? And they'll say, that's it. And I'll say, okay, I need to have the total number of business miles that you drove, and I need to also know how many other miles you put on the vehicle for the year that were not business. Oh, I didn't track that. Well, they're required to know that, because that information has to be disclosed on the tax return. So typically, even after I've told this to my client year after year after year, they're always still coming to me with part of the numbers, not all of the numbers. Frequently, I'll have a client who will give me a number. This is my business mileage. So I'll send them an email and say, thank you for the business mileage. I also need to know the total of all miles you put on the vehicle during the year, and I need to know the total of all commute miles you put on the vehicle for the year. Well, I included commute in with the other business miles. Well, you can't do that. I need to have you pull commute out. Well, why? Well, because the IRS considers commute to be personal. It's not an allowable business expense. I need to know what your commute was. Well, I don't know what my commute was. I didn't track that separately. So this is always leaving me with a dilemma. Is like, how good is your mileage log if you don't know these answers? And how much will it matter if they ever get audited? Well, I've had the opportunity, I wouldn't call it the pleasure, but I've had the opportunity to be in a number of audits where IRS has looked at employee business expenses claimed on a tax return. And the record-keeping expectations that the IRS auditors have are actually not as strict as one might think, or at least I would have thought. If the person did not keep a perfect mileage log, they do seem to be willing to work within the scope of what numbers that the worker or taxpayer is providing. But they want more verification than just the log. For example, they might want to have documentation coming from a Jiffy Lube type place that shows beginning and ending odometer readings for a 12-month period, so that if the taxpayer has claimed 20,000 business miles, and they're saying that they also had maybe another 5,000 of personal miles, that during a 12-month period they should have put 25,000 miles on the car, and how can that be verified from an outside source? Well, Jiffy Lube typically takes an odometer reading each time it changes your oil, so you could find like a 12-month period there and see if you've come up with 25,000. So I've actually seen auditors ask for those Jiffy Lube readings. Now, if a person changes their own oil, and I did have a client who does that, changed his own oil, and he was audited, I happened to notice that when he did present his mileage log, and he was very well behaved in that regard, his mileage log actually showed the dates he did oil changes. I was actually rather impressed by that. He must have talked to other people in his union to figure out that he needed to actually write down his mileage each time he did an oil change. Or maybe that's just common sense. You're writing down the mileage when you do an oil change so that you know when you need to do your next oil change. That could be that reason as well. But the auditor was satisfied with the fact that that information had been documented. And speaking of that contractor who was claiming mileage expense, you might be scratching your head and saying, well, I thought you said that contractors couldn't claim mileage expense. Actually, what I said is that contractors who don't have, or construction workers who do not have a fixed work location and instead are traveling all over the metropolitan area, they cannot claim transportation costs inside their metropolitan area. But I quite often have construction workers who are traveling outside of their metropolitan area. And if you do have a construction worker with no regular fixed work location who ends up traveling outside of the metropolitan area, that is allowed. And the beauty of transportation outside of the metropolitan area is it's really easy to reconstruct records. I did help 2 different tax clients through IRS audits where they had temporary work assignments outside of the metropolitan area, and we were able to use reconstructed records using MapQuest and dates that they were physically present at those temporary locations to arrive at a final mileage number, and the auditors took that quite readily. It wasn't even questioned, because the MapQuest was accepted as the appropriate drive distance from their home to the temporary work site outside of metropolitan area, but also the verification of how many times they might have made that trip came from alternative sources like hotel receipts and letters from employers and letters from the union and so forth about how much time they had spent at those locations and how many trips they might possibly have made. So if you have a person who has no regular fixed work location inside the metropolitan area, but they are temporarily assigned outside of metropolitan area, that temporary assignment outside of metro does qualify. Now, whether they are claiming actual expenses or the standard mileage rate, however, we're still left with this problem of verifying the actual miles driven. And the reason we need to verify the miles driven, whether you are working off of the standard mileage rate or actual expenses, is that you still need to show what the percentage business use of the vehicle was. So let's just suppose you have a vehicle that you put 20,000 miles on in a year, and 10,000 of the 20,000 are business miles. You have to be able to substantiate that $10,000 number. And if you decide that it's just too complicated to keep a log, that you'd rather just total up your expenses so you can claim those, when you're finished totaling up all of your expenses, you still have to figure what percentage of the expenses you're going to be allowed to claim. And here's an example. You drove your car 15,000 miles during 2012, and 10,000 miles were personal, with 5,000 being for business. Your actual cost for operating the vehicle was $7,000 for the year. Figure your allowable deduction as follows. So you're going to take 5,000 business miles, divide that by 15,000 total, multiply that by the actual costs you incurred, and you're left with $2,333, which, by the way, is less than you'd get by claiming the standard mileage rate. So claiming actual doesn't necessarily put you ahead, and the standard mileage rate is so generous that I usually find my clients are far better off claiming it, in which case, whether they claim actual or standard, they still have to keep a mileage log. And when it's a choice between the two, the standard mileage rate usually gives a higher rate. But if you have a client who drove a small number of miles total, let's just suppose they have a car that during the whole year they put 10,000 miles on it, and that 6,000 of those 10,000 miles were business miles, and the vehicle was a full-blown Denali Suburban costing $50,000, $60,000. Well, they're going to be able to claim a really big depreciation deduction on that vehicle, even after you apply the business use percentage limits. So they'd probably choose to claim actual expenses over standard mileage. But unless you're in a situation like that, your typical person driving the typical car out there, the standard mileage rate is going to give them a better deal. So business versus personal use. If you use your car for business and for personal use, you must maintain adequate records to show your business use. Acceptable methods of tracking business use include: keep a mileage log. The log should show the following: the dates you drove, the places you traveled to, the miles that you drove, and the reason for your travel. Or number 2, use your personal calendar of appointments to log the miles driven for your appointments. I personally like this one a lot. You keep a calendar on the wall, and each day when you finished your driving, you kind of make a note on a piece of paper somewhere what you drove, and then you put it on the calendar. And then at the end of the year, you add it all up. That's just one I prefer when I've used it myself. But, you know, they do sell mileage logs over at Office Depot. They're nice little booklets that you can keep in your car and should keep in your car, and you should be filling those out as you go. IRS says either of those is fine. You may use actual expenses or the standard mileage rate in any year. However, generally you will not be able to claim the standard mileage rate in any year following a year where you claimed actual expenses and then claimed depreciation on your vehicle while you were doing it. In most cases, this means you cannot claim the standard mileage rate in any year after a year that you claimed the actual expenses for that same car. But once you dispose of that car and get a new car, you could begin claiming standard mileage again on the new car. Interest on car loans. Whether you claim a deduction for interest you paid on your car loan depends on if you are self-employed or if you are an employee. If you are an employee, you can never deduct the cost of interest on a car loan as an employee business expense. That rule is specifically highlighted in IRS Publication 463 on page 16. Not allowed, can't do it if you are an employee. But if you are self-employed, the IRS does allow you to figure a portion of the interest that you pay on your car loan as a business expense and claim that on your Schedule C. Now there's an interesting thing here. For many, many years, because of this rule specifically outlined in Publication 463, I've had it in my head that you cannot deduct as an employee business expense any interest of any kind. That credit card interest that you use for your business, for example, would not be allowed. And I had it in my head that that's been a rule for a very, very long time. But this past tax season, I had a gentleman come to me who was questioning how we'd prepared his return. He thought that we hadn't been aggressive enough, that we had left off deductions he felt he was entitled to claim. And so I said, well, okay, let me look at it again. Let me interview you very carefully. Let me analyze every deduction that you think you should be allowed to claim. And I'll do the research necessary to back up every decision that we ultimately claim on your return. Well, one of the big deductions he wanted to claim that I thought he shouldn't be able to claim was credit card interest. And why did he have credit card interest? Well, his job is kind of an odd one, but this is what his job was. He was hired to manage a health club, a pretty big fancy one here in town. And the investor or the owner of the company in this health club was asking him to front money to contractors and to Home Depot to purchase construction materials for all of the work being done on this health club. Well, he was doing all of this as the recession hit 2007, 2008. And early on in that relationship, his employer was reimbursing him for the credit card interest and was also reimbursing him for any amounts he paid to those contractors and to the Home Depot. But then the employer stopped reimbursing him. The employer was in financial trouble, eventually declared bankruptcy. The club was closed, and there he was left with all of these bills. And not only that, he had contractors who were coming after him for money because he, on behalf of that company, had signed agreements with them. So the whole thing was an ugly mess and has cost him a fortune. And he wanted to be able to claim all of those losses, including the credit card interest. And so I thought, well, okay, I need to prove to him that he can't claim the credit card interest. And the only thing I could ever find was this reference to cars. So I got on the phone with the tax practitioner hotline, the IRS hotline for tax practitioners, and said, okay, I am very certain that interest is not allowed as an employee business expense. And she said, yes, I agree with you. And I said, but I can't find it anywhere in writing that you can't do it. I can find that you can't do it for cars, but I can't find that you can't do it anywhere else. Can you check into this for me? And so she went around and talked to the other people in the department, people who knew more about it than her, who had been there longer than her, and everyone was saying the same thing. We're pretty sure you can't do it, but we can't find it. So finally they said, okay, we're going to have to put this through to the research department so they can research it for you. And about 5 to 6 days later, I got an email from the research department, and the research department said, you can claim it. So there was something that after 20 years I had been telling my clients they couldn't do something when they could, but I don't have it anywhere in writing that you can claim it. And where it was in the past that I remember reading it or thinking it, I don't know. Other than that, I took this rule relating to cars and assumed it applied to everything else. But that's not the case. So hopefully I've made an impactful piece of information there for you. But one of the things we did have to look at in terms of credit card interest and whether or not it's allowable is that you have to be able to substantiate that there was a business use of the credit card, that the debt was incurred solely for the business, that it was necessary for you to pay that interest. You still have to pass all of those tests. And so we filed this man's tax return claiming all of these deductions. I've told him to expect an audit. I think that the amount of the deductions is significant and that he could get audited. So I haven't been through that phase yet, or it may never happen. But I was very careful to document every step of the way on his return. And anytime you are in a questionable situation with a client on deductions like this where you're feeling a little bit out of your realm, I would advise you to do what I did, which is carefully research, and at the last step, call the tax practitioner hotline and make records, keep notes of everything that went on in that conversation in case it ever does come to the audit point. So let's move on to the next topic, which is if you sell, trade in, or otherwise dispose of a car that you used for your business. If you sell, trade in, or otherwise dispose of a car that you used in your business, you will need to report the disposition of the vehicle on Form 4797, Sale of Business Property. This is because you will need to determine whether you have a gain or a loss on the disposition of the vehicle. You determine the amount of your gain or loss by subtracting the sales price of the vehicle from your cost basis after factoring for depreciation. You must factor for depreciation even if you claim the standard mileage rate instead of actual expenses. Next week I'm teaching basis of assets, and then following that I'm teaching depreciation made easy. And in depreciation made easy we go into quite a big discussion of how much depreciation is factored into the standard mileage rate. And then later on in our course called Sale of Assets, which follows depreciation, we get into how you would reduce the basis of an asset by the standard mileage rate and figure a gain or a loss on Form 4797. For today, I'm just explaining that if you have a client who used their car for business as an employee and they claimed depreciation on that vehicle or they claimed the standard mileage rate on that vehicle and then they later disposed of that vehicle, they are disposing of an asset that was used in a trade or business, and that disposition needs to be reported on 4797. And here I have an illustration. Miss Jan sold her 1998 Ford Taurus for $3,000. In earlier years, she claimed expense deductions for the car. Since she previously claimed a deduction for business use of her Taurus, she will need to report the sale of that vehicle on Form 4797. Well, what happens if Jan disposes of the car in another way? It doesn't really make a difference. In illustration number 2, Jan totaled her 1998 Ford Taurus. The vehicle was not insured, and she received no payment for scrap value. Since Jan previously claimed a deduction for business use of her Taurus, she has to report that disposition of her car on Form 4797. So that's the conclusion of the discussion on local transportation costs. Now we're going to look at transportation costs outside of your metropolitan area, and when we do that, we call it travel expense. To claim travel expense, you must have a regular place of abode in a real and substantial sense. You have a regular place of abode if all of the following is true. You work in the same vicinity as your claimed abode and you use it while you're doing business. Your living expenses incurred at your claimed abode are duplicated when you're away on business, and you have not abandoned the vicinity in which your place of lodging and claimed abode are both located, or you have family member or members, marital or lineal, currently residing at your claimed abode, or you use the claimed abode frequently. Tax home. In order to have travel expenses, you have to travel away from your tax home. That means you need to understand what a tax home is. Your tax home is your regular place of business or your post of duty, regardless of where you maintain your family home. So it's possible your tax home and your family home are entirely different. It includes the entire city or general area where your main place of business or work is located. You can claim the cost of expenses you incur while traveling away from your tax home overnight. Well, right now I have a client. This is an important detail. I have a client who's taken up a temporary job in San Francisco. He's a shoe designer, and Portland, Oregon is full of shoe designers, particularly in athletic apparel department. After all, Nike's headquartered here, but lots of other sports apparel, shoe apparel companies have big offices here. So he's got a talent. He designs footwear for sports apparel companies like Nike's and others, and he's been offered a temporary to permanent job in San Francisco. He's got a bit of a dilemma going on because once he starts working in San Francisco without actually moving away from Oregon, because that's not his intention, his tax home is going to be associated with San Francisco if that's where he spends the majority of his working time. So if he gets on a plane and flies to San Francisco for 3 days a week and then spends the other 4 days a week here in Portland, the question is, where is his tax home? His main home, his place of abode, is still Portland, but if he's traveling to San Francisco and he's working in San Francisco and all of his income is now coming from San Francisco, that could make San Francisco his tax home. So is he going to be able to deduct travel expenses between Portland and San Francisco? That's the question. And it's a pretty distinctive set of rules that are going to apply to whether or not he will be able to deduct those expenses. And it is possible he could. It's also possible he cannot. And in the end, it's going to work down to whether the assignment in San Francisco is temporary or permanent. And if it's temporary, he can deduct those temporary travel expenses. If it's permanent, he's not going to be able to deduct them. So you can claim the cost of expenses you incur while you travel away from your tax home overnight. If you do not have a regular place of business or post of duty, and there is no place where you regularly live, you are considered to be a transient, and your tax home is wherever you happen to work. As a transient, you can never be away from your tax home, so your travel expenses are never deductible. Main place of business or work. If you have more than one place of work, consider the following when determining which one is your main place of business or work. The total amount of time you ordinarily spend in each place, the level of your business activity in each place, and whether your income from each place is significant or insignificant. Traveling away from home. You are traveling away from home if your duties require you to be away from your general area of your tax home substantially longer than an ordinary day's work, and you need to sleep or rest to meet the demands of your work while you are away from home. This rest requirement is not satisfied by merely napping in your car. You do not have to be away from your tax home for a whole day or from dusk until dawn as long as your relief from duty is long enough for you to get necessary sleep or rest. I have a couple of illustrations here that I've pulled out of IRS publication 463. One of them is for qualifying travel, and the other one is for non-qualifying travel. And they are similar, but there's a subtle difference between them. In example number 1, you are a railroad conductor. You leave your home terminal on a regularly scheduled round-trip run between 2 cities, and you return home 16 hours later. During the run, you have 6 hours off at your turnaround point, where you eat 2 meals and rent a hotel room to get necessary sleep before starting the return trip. You are considered to be away from home in that illustration. Illustration 2. You are a truck driver. You leave your terminal and return to it later the same day. You get an hour off at the turnaround point to eat. Because you are not off to get necessary sleep and the brief amount of time is not adequate for a rest period, you are not traveling away from your home. Temporary assignment or job. So in order to claim travel expenses, you have to be traveling to a temporary assignment or job. Let's look at what that means. You are temporarily assigned to a job at a location away from your tax home, or if you are temporarily assigned to a job at a location away from your tax home, you can deduct your temporary living expenses as travel expenses subject to the following. Your assignment must be considered temporary in order for you to claim the expense. A temporary assignment is one that you realistically expect will last 1 year or less and does in fact last 1 year or less. in order to be able to claim travel expenses, you have to have a temporary assignment. And the assignment must be considered temporary in order for you to claim the expenses. IRS says a temporary assignment is one that you realistically expect will last 1 year or less, and does in fact last 1 year or less. If your assignment is indefinite, that is expected to last more than a year, or you don't really know how long it's going to last, it's indefinite, you don't know, the location of your assignment becomes your new tax home and the cost is not deductible. Determining temporary or indefinite. To determine if your travel is temporary or indefinite, you should apply the following rules. Number one, if you are indefinitely assigned to a work location, that work location becomes your tax home. You must determine if your assignment is indefinite or temporary when you start the job. You may claim temporary living expenses while you are away from home up until the day you first become aware that your assignment has become indefinite or will last more than a year. So what this is saying is, let's just suppose you accept a temporary contract to work for a particular company on a project for 6 months. The end of that 6 months comes, and they say to you, well, we're still not complete. We would like to sign you on for another 6 months. Well, 6 plus 6 is exactly a year. It's not more than a year. It is a year. So it would still be considered temporary. But let's suppose that 4 months into the second 6 months, in other words, 10 months into that first year, the employer comes to you and says, well, it looks like this project is going to run another 6 months longer than we had expected. So on the 10th month, you learn it's going to run more than a year. And on that day that you learn it's going to run more than a year, the assignment is no longer temporary. And that means you could claim all of the temporary travel expenses and lodging expenses for the first 10 months. But from the 11th month forward, where you knew it would no longer be temporary, nothing would be deductible. Now, members of the armed forces who are on permanent duty assignment overseas are not traveling away from home. And naval personnel assigned to ships with eating and sleeping facilities are considered to have a tax home aboard ship for tax purposes. You are on a probationary assignment with the understanding that you will keep your job upon satisfactory completion of the probationary period. In this situation, your assignment is considered indefinite for travel purposes. So going back up to this header here, is it temporary or indefinite? It's considered to be indefinite if you take a probationary assignment, and at the end of that probationary assignment, it's going to become permanent. So in other words, you're hired. They don't know if they're going to like you and keep you, but there's a possibility that they will like you and they will keep you. And if that's the case, it's permanent. It's not temporary. Going home on your days off. This is from IRS Pub 17, page 177. You would find the same information in publication 463. If you travel home on your days off to visit your family, you can claim travel expenses equivalent to what meals and lodging would cost you had you stayed in a temporary location. This rule applies only if you are assigned to a temporary location away from your tax home. If your temporary assignment is expected to last more than a year, you cannot claim the cost of expenses you pay for your temporary home or meals. And there's a note here. If your assignment away from your family home is indefinite or is expected to last more than 1 year, you cannot deduct any costs associated with traveling to your family home on your days off. However, if you travel away from your tax home to the vicinity of your family home for legitimate business reasons, you can deduct the cost of business travel to the vicinity of your family home. IRS Pub 17, you would look on page 176 for more information on that. So let's think about what this is saying for a minute. I have my family home. It's in my tax home. And I accept a temporary position for 6 months in another city. IRS says I can deduct the cost of traveling from my family home to that city and all of the cost it costs me to live in that city on a temporary basis. But what about if I want to come home each weekend? Can I deduct the cost of traveling home every weekend? It seems logical that you would be able to. And the IRS is sort of saying yes, but it's saying you can only claim the cost of traveling home that is equal to what it would have cost you to stay in that city. Well, let's look at the conditions under which you might be staying in that city. Perhaps you're renting a house for 6 months. So whether you're home in that house over the weekend or not, the monthly rent would be the same, right? So staying in the city isn't going to be a whole lot more money than traveling home. Or it wouldn't be perhaps any more money than traveling home, because whether you stay or go, it's still that flat monthly rent. So that's something that you'd have to consider. What would be extra of staying in that city? Well, I suppose your meal allowance would be extra, so you could figure that out. So if you're traveling from a temporary work location home for the weekend, you'd have to be really figuring or determining how much more it's costing you to stay in that city than it is to travel home. And to the extent that it costs you money to stay in that city, you can allow that much as a cost of traveling home. So let's do another example that might be possible, because I think in that first illustration you pretty much ruled that there's not going to be much allowed for the cost of traveling home. But let's suppose you live in a city that is 200 miles from the city that you're temporarily assigned to. So 200 miles is a bridge that you could cross on weekends. You could travel the 200 miles home on Fridays after you finish your job, and then Sunday drive the 200 miles back to that job again. It's conceivable that you would do that. And when you arrive at that temporary location, you're always in a hotel. So 5 nights a week, Sunday through Thursday night, you're always in a hotel. And you don't stay in the hotel on the Friday or the Saturday because that's when you've come home. So how much would the hotel have cost you if you did stay the weekend? And if it costs you $100 a night, then it would cost you $200 to stay in that temporary work location. But you don't have to pay the $200 for staying in the temporary location because you came home. And if it costs you 100 miles each way to come home, then it costs the same to come home as it does to stay there, so IRS would allow that. But let's just suppose it only costs you $50 to come home and go back. Well, then your deduction would be limited to the $100 you actually spent going home and coming back. Or let's suppose it costs you $200 to come home, $200 to go back, but the hotel would have only been $200, then your deduction would be limited to $200. So that's essentially what this first bullet point is saying, and it's kind of hard to make sense of it until you put it into a situation like I described.
Android, A-N-D-R-O-I-D, Android.
So we're going to now move on to the qualifying travel expenses, and IRS considers travel expenses to be ordinary and necessary expenses of traveling away from home for your business, profession, or job. In order to deduct them, you have to be able to show that the primary reason for your trip is business. Now we can look at when a trip is primarily for business and compare that to when a trip is primarily for personal reasons. So when is a trip primarily for business? Because the IRS says in order to deduct business travel, the purpose of the trip needs to be primarily for business. They're not saying you can't have a little bit of fun while you're gone, but you can't have a trip for fun and then call it business. The trip needs to be for business, and then a little fun on the side is okay. If your trip is business and primarily for business, then you can deduct all of your necessary travel expenses, but you may not deduct costs associated with personal side trips or to lengthen their stay for personal reasons. And here we have an illustration. I love Hawaii. There's something about Hawaii that's totally vacation. Can't be stressed out about a single thing when I'm in Hawaii. And there's a convention in Hawaii, so we're going to travel to Hawaii for that convention. The convention lasts for 3 days, but you decide to stay a week to enjoy a short vacation. You may deduct the cost of traveling to and from Hawaii and the costs associated with meals and lodging surrounding the convention. The costs for meals and lodging you incur during your additional vacation time are not deductible. Let's look at a trip that is primarily for personal reasons. If your trip is primarily for personal reasons, you cannot deduct any of your travel expenses at all. But if you incur direct business expenses while you are on your trip, you can deduct those business expenses. And here is an illustration where we have a personal business trip. We have a personal trip that is not business. You travel to Hawaii for a week's vacation, and while you are in Hawaii, you attend a one-day seminar related to your business. You cannot deduct any of the costs associated with travel to or from Hawaii, and you cannot deduct the cost of lodging or meals while you are in Hawaii. But you could deduct the cost of attending the seminar. So I use these two illustrations here because it's not uncommon at all for a client to come and present this trip they took as a business trip, when in fact it was questionable whether or not it was a business trip. And just in casual conversations with people, some event somewhere, and they find out I do taxes, so naturally, I'm sure you've experienced it as tax practitioners, that people start asking you tax questions. They love to do that. And they'll throw things, well, I'm going to take this business trip and call it a business trip, but it's really going to be a vacation, but I'll be able to deduct it if I do something that's business on the trip, won't I? And the answer is no. You know, you can't take a personal vacation and call it a business trip just because you happen to throw in a business activity while you're there. You really have to have a motive for the trip that's business. You're there for business. The primary reason for the trip is business. If you pass those tests, then it is okay to have a little bit of fun, and it's even okay to stay a little bit longer and enjoy yourself. But you're not going to be able to deduct expenses that were for additional time you spent enjoying yourself or related to enjoying yourself and were not incurred because of the business activity. And what about the cost of bringing friends and family members with you? The additional costs that you pay to bring friends or family members with you are not deductible. Here we have an illustration. Spouse travels with you to Hawaii again. You travel to Hawaii to attend a 4-day seminar. Your spouse decides to travel with you. Because of a package deal, you were able to purchase the cost of staying in Hawaii for 7 days at the same cost it would have cost you to be there for 4 days. Lots of hotels have that. If you stay there for 4 nights, the 5th night's free. Or if you stay there for 3 nights, the 4th night's free. It's possible if you have a condo that they might have a weekly rate that's the same as 4 days of totaled up. But you've got some kind of a deal like that where it's going to be the same either way. You can deduct all of the costs for yourself of travel, meals, and lodging, but you couldn't, of course, deduct any meals associated with the 3 days you stay extra if they were any more money than it would have cost to stay there only for. But regardless of what you can or can't do for yourself, you cannot deduct any costs associated with your spouse traveling with you. This is true even if your spouse assists you with performing job duties. So those are just general rules about travel, and when we talk about travel, most of the time, with most of my clients at least, it's travel inside of the United States. I don't deal with a whole lot of travel outside of the United States, but of course that would come up, and depending on the firm you have that you work in and the clientele that you have, international travel could be quite common. But when you get to the concept of international travel, IRS rules governing the deductibility of expenses for travel outside of the United States are different and more restrictive than they are for business travel inside of the United States. And when you're talking about United States, that means the 50 states and the District of Columbia. How much of your travel expenses that you can deduct depends in part on how much of your trip outside of the United States was business related. You can deduct all of your travel expenses of getting to and from your business destination if the travel was either entirely for business or considered entirely for business. So what does it mean to be considered entirely for business? Even if you did not spend your entire time on business activities, your trip is considered entirely for business if you meet at least one of the 4 following exceptions. Exception number 1 is you had no substantial control. Your trip is considered entirely for business if you did not have substantial control over arranging the trip. That is, your employer arranged it for you and said, get going. You do not have substantial control over your trip if all of the following apply. You are an employee who was reimbursed or paid a travel expense allowance, and you are not related to your employer, and you are not a managing executive. And you can refer to Publication 463, Chapter 6 for definitions of related to employer and managing executive. It's not hard to imagine what they are, but if you have any questions, your client has any question, go to Publication 463. Exception number 2, you're outside of the United States, but not for more than a week. So you're outside of the United States for 7 days or less. Your trip is considered entirely for business if you were outside of the United States for a week or less, combining business and non-business activities. 1 week means 7 consecutive days. And in counting days, do not count days that you leave the United States, but do count days where you return to the United States. So here is an example of travel outside of the United States, where travel outside of the U.S. was not more than 1 week. You traveled to London on a trip that was primarily for business. You left Austin on Tuesday and flew to New York. Wednesday afternoon, you boarded a flight to London and arrived in London on Thursday morning. On Thursday and Friday, you had business discussions, and from Saturday until Tuesday, you were sightseeing. You then flew back to New York and arrived on Wednesday afternoon. On Thursday, you flew back to Austin. You left on Wednesday, you returned on Wednesday, and if you count your fingers, you'd come up with 8. But you don't count the first Wednesday because that's the day you left. And therefore, you're left with 7 days, and 7 days is not more than 7 days. It is 7 days, and so you meet that test. So although you were away from your home in Austin for more than a week, you were not outside of the United States for more than a week. This is because the day you depart does not count as a day of travel outside of the United States. Your travel expenses are deductible as follows. You can deduct your cost of the round-trip flight between Austin and London. You can deduct your cost of your layover in New York. You can deduct the cost of your stay in London for Thursday and Friday while you conducted business, but you cannot deduct the cost of your stay in London from Saturday through Tuesday because those days were spent on non-business activities. Exception number 3, less than 25% of your time is spent on personal activities. Your trip is considered entirely for business if you were outside of the United States for more than a week and you spent less than 25% of the total time you were outside of the United States on non-business activities. Example, you traveled for 21 days on a business trip from Los Angeles to Beijing as follows. You spent 14 days on business, you spent 5 days sightseeing, and you spent 1 day flying in each direction. Because only 5 of the 21 days, 5/21ths, is less than 25% of your total time abroad, then only less than 25% of your time was spent on non-business activities. And that means you can deduct as a travel expense what it would have cost you to make the trip had you not engaged in any non-business activity. The amount you can deduct includes the cost of your round-trip airfare and the 16 days of meals, lodging, and other related expenses. Exception number 4. Vacation was not a major consideration. Your trip is considered entirely for business if you can establish that a personal vacation was not a major consideration for the trip, even if you have substantial control over arranging the trip. Travel primarily for business. If you travel outside of the United States primarily for business but spend some of your time doing personal activities, the following rules apply. So we've just finished looking at when you have travel that is considered entirely for business and what factors the IRS uses to determine whether or not that trip is entirely for business. And if you can establish under one of those 4 exceptions that the trip is entirely for business even though you had a side trip, then all of the cost of getting to and from that business destination is allowable. So if it costs you $2,000 for round-trip airfare to Paris, France, and while you're in Paris you do some personal vacationing prior to or at the end of your trip, as long as you meet one of the 4 tests, then you would be able to deduct the entire $2,000 of airfare. But let's just suppose you don't meet one of those 4 exceptions, that you fail those 4 exceptions, so you can't say that the trip was entirely for business. Then we look at travel that may still be considered primarily for business. Maybe you went there primarily for business, and while you were there you did some other stuff. Are you going to still be able to deduct that trip, that airfare of $2,000 going back and forth to Paris? And the answer is partially. So let's see how the IRS arrives at new numbers for partially deductible cost of travel. If you traveled outside of the United States primarily for business, but spend some of your time doing personal activities, the following rules apply. You can deduct the business portion of your cost of getting to and from your destination. You must allocate or prorate other travel costs between your business and personal activities to determine your deductible amount. And here are the allocation rules for travel outside of the United States. If your trip outside of the United States was primarily for business, you must allocate your travel time on a day-to-day basis between business days and non-business days. The days you depart from and return to the United States are both counted as days outside of the United States. To figure the deductible amount of your round-trip travel expenses, use the following fraction: the total number of business days outside of the United States and the total number of business and non-business travel days. Counting business days. Your business days include transportation days, days your presence was required, days you spent on business, and certain weekends and holidays. Transportation day. Count as a business day any day you spend traveling to or from a business destination. However, if because of a non-business activity you do not travel by a direct route, your business days are the days it would take you to travel a reasonably direct route to your business destination. Extra days for side trips or non-business activities cannot be counted as business days. There's also this presence required rule, and it says, count as a business day any day your presence is required at a particular place for a particular business purpose. Count it as a business day even if you spend most of the day doing things other than that business activity. So just maybe you have to be present for a particular meeting that is 1 hour at an office structure. You have to be present in that meeting, and aside from that, you're on your own. That would still be a business day. Days spent on business. If your principal activity during working hours is the pursuit of your trade or business, count the day as a business day. Also count as a business day any day you are prevented from working because of circumstances beyond your control. Certain weekends and holidays. Count weekends, holidays, and other necessary standby days as business days if they fall between business days. But if they follow your business meetings or activity and you remain at your business destination for non-business or personal reasons, you cannot count those days as business days. And here we have an example where the weekend falls between business days. Your tax home is San Francisco and you travel to Vancouver, Canada, where you have a business meeting on Friday. You have another appointment on the following Monday. Because your presence was required on both Friday and Monday, they are business days. The weekend is between business days, therefore the Saturday and Sunday are counted as business days. You can count the weekend days as business days even if you use that time for sightseeing, visiting friends, or other non-business activities. Example number 2. The weekend falls after business days. Assume the same facts as in example 1, except you have no business activity in Vancouver on the Monday. So technically you could go home on the Saturday, but instead you stay until Monday and fly home on Monday. Since there is no business need to stay in Vancouver on the Saturday or the Sunday, then those are considered to be non-business days. Non-business activity on the way to or from your business destination. If you stop for a vacation or other non-business activity, either on the way from the United States to your business destination or on the way back to the United States from your business destination, you must allocate part of your travel expense to the non-business activity. The part you must allocate is the amount it would have cost you to travel between, and these bullet points took me a while to absorb them. If you read the IRS publication 463, you have to sit there and read it like 10 times before you get it. So I finally got it, and I underlined it. And I'm just pointing it out because in a minute we're going to talk about something that sounds almost exactly the same, but the difference is the underlined word in each of the bullet points. So the part that you must allocate in terms of the cost of the travel, that airfare, from the United States to the business destination and then to the non-business destination and then back again, you have to be looking at some allocation going on there. The part that you must allocate is the amount it would have cost you to travel between the point where the travel outside of the United States begins and your non-business destination, and the return to the point where your travel outside of the United States ends. So what they're saying is, okay, you look at if you'd never gone to the business destination, if the only place you went was the non-business destination, how much would it have cost round trip to get to and from there? That's the allocation that they're looking for. You determine your non-business portion of that expense by multiplying it by the following fraction: the number of non-business days during your travel outside of the United States and the total number of days you spent outside of the United States. Well, none of that makes any sense at all, so let's put it into an illustration. There's a similar illustration in publication 463. I adapted it and changed it a little bit, and then just so that you'd have something different. You can still go read publication 463 and you'll see it's very similar, but I wanted to word it differently and make it work a little different. And then I also created this diagram to kind of show you what the illustration is talking about. You live in New Jersey, and on June 12th, you flew from Frankfurt to attend a business conference that began on June 13. The conference ended at noon on June 21st, and that evening you flew to London, where you visited with friends until the afternoon of June 29. You then flew directly home to New Jersey. The primary purpose of the trip was to attend the conference. So you flew from New Jersey to Frankfurt, and then you could have come directly home, but you chose not to. You decided that you would go to London, which is a non-business destination, right here, non-business destination, and then from London, you flew home back to the United States. So this is essentially an indirect route home. If you had not stopped in London, you would have arrived home on the morning of June 22, and you do not meet any of the exceptions that would allow you to consider your trip entirely for business. June 12 through June 22, 11 days are business days, and June 23 through June 29, 7 days are non-business days. You can deduct the cost of your meals subject to the 50% limit. You can also deduct the cost of lodging and other business-related travel expenses while you're in Frankfurt. You cannot deduct your expenses while you're in London, and you also cannot deduct 7/18 of what it would have cost you to travel round trip between New Jersey and London. Your travel costs were as follows. I find it interesting, this entire formula. I would think logically that we would look at the round trip cost of airfare from the United States to Frankfurt, and then you would look at how much extra you paid to go to London and just not deduct that part. But the IRS doesn't have you do it that way at all. They have you use this really complex formula. So let's see what's going on here. So you cannot deduct your expenses while in London. You also cannot deduct 7/18, because 7 out of 18 is how many personal days you had, of what it would have cost you to travel round trip between New Jersey and London. Your travel costs for the entire trip were as follows. $750 to fly from New Jersey to Frankfurt, $400 to fly from Frankfurt to London, and $700 to fly from London back to New Jersey. Total cost of that airfare, $1,850. Now, had you just decided to travel on a trip to London, that round-trip airfare would have been $1,250. So you figure the deductible part of your airfare expense as follows. You multiply the cost of the direct round trip to London by the fraction shown below. $1,250 multiplied by 7/18 equals $486. You then subtract $486 from this number here, $1,850. And when you do that, you have your deductible airfare expense, $1,364. Non-business activity at, near, or beyond the business destination. Now we're going to compare this concept with what we just had. In this first concept here, we have a trip that's primarily for business but not entirely for business. And we have a personal side trip that's on the way home. We're going to compare that to a second situation where the non-business activity is at the business location or near or beyond the business destination. If you had a vacation or other non-business activity at, near, or beyond your business destination, you must allocate part of your travel expenses to the non-business activity. The part you must allocate is the amount it would have cost you to travel between the point where travel outside of the United States begins and your business destination, and a return to the point where travel outside of the United States ends. And here we've got your business destination. So earlier we were looking at the cost of traveling to the non-business destination, what it would have cost you to fly round trip to the non-business destination. Well, now they're not even considering that. Now they're looking at what it costs you to fly round trip to your business destination and doing the factoring on that. So that's the key word that differs the 2 bullet points here from the 2 bullet points earlier. So you're going to have to do an allocation, and the allocation is based on the amount it would have cost you to travel between the point where travel outside of the United States begins and your business destination, and a return to the point where travel outside of the United States ends. You determine the non-business portion of that expense by multiplying it by the following fraction, which is the number of non-business days during your travel outside of the United States divided by the total number of days you spent outside of the United States. Now, none of your travel expenses for non-business activities at, near, or beyond your business destination is deductible. And here's an example of how all of that worked. Assume that the dates are the same as in the previous example, but that instead of going to London for your vacation, you decided to fly to Venice, Italy for a vacation. Venice, Italy is not between the United States and Frankfurt. It's obviously off in another direction. You had the following expenses for this trip. Lodging, meal, and other expenses while you were in Frankfurt was $4,000. Airfare and other travel-related expenses from New Jersey to Frankfurt is $1,750. You spent $2,000 traveling to Venice. You cannot deduct any part of that $2,000 cost of your trip from Frankfurt to Venice and the return to Frankfurt. But what about this cost of traveling to Frankfurt? Well, that's now going to have to be prorated. And essentially, we've got New Jersey to Frankfurt, which is the business destination, the direct route, and then we have this personal side trip to Venice. So we're going to cross off Venice. We get nothing for that. And when it comes to the cost of the airfare traveling from New Jersey to Frankfurt and Frankfurt back to New Jersey, now we're going to have to do an added calculation based on the ratio that we described here. So let's see how that works. In addition, your deduction for the other business travel expenses will be limited as follows. You cannot deduct 7/18 of the airfare and other expenses from New Jersey to Frankfurt and back to New Jersey. You can deduct, however, 11/18 of the round-trip plane airfare and any other travel expenses from New Jersey to Frankfurt multiplied by that 11/18 amount. You can also deduct your meals, subject to the 50% limit, lodging, and any other business expenses that you had in Frankfurt. You're going to figure your deduction for travel-related expenses as follows. 11/18, which is the number of business days out of the total number of days of travel, multiplied by the travel expense. And when you do that, you get $1,069. Your allowable deduction for travel expenses would therefore be $5,069. The $1,069 for the travel to and from Frankfurt, plus $4,000 for lodging, meal, and other expenses while you were in Frankfurt. Other methods. You can use another method of counting business days if you establish that it more clearly reflects the time you spent on other than business activities outside of the United States. Travel primarily for personal reasons. If you travel outside of the United States primarily for vacation or investment purposes, the entire cost of the trip is non-deductible as a personal expense. However, if you spend some time attending brief professional seminars or a continuing education program, you can deduct your registration fees and other expenses that you have that are directly related to your business. Okay, so we've talked about the customary method of business travel, which is flying on an airplane. What about going by boat? It's conceivably possible that you could get to London on a boat, right? Like that was how they did it in the olden days when there was no planes. People got from country to country on a boat. Business went a lot slower back then. I've just been watching for the second time a show last night called John Adams, and it's about one of our founding fathers of our nation and the Declaration of Independence and King George III. And the colonials sent a letter to King George III, and it took several months for that message to get to King George and back. So things have definitely changed, but it is still possible to travel to a business destination via water. You could choose to do that. And if you do decide to travel to a business destination by water, there's some limits on that, luxury water travel limits. If you travel by ocean liner, cruise ship, or other form of luxury water transportation for business purposes, there is a daily limit on the amount that you can deduct. The limit is twice the highest federal per diem rate allowable at the time of your travel as shown in the following table. So we've got the date of travel, and depending on the date that you traveled, the highest federal per diem rate is shown in these boxes. And you take that number and double it, and that would be the amount you're allowed to deduct for each day of travel if you decided to travel to your business destination on a luxury liner. So this is not saying your business destination is the luxury liner. It's saying you're using the luxury liner to reach your business destination. And if that's the case, you can deduct it subject to these limits. And here is an example where the cost of travel is greater than the daily limit. Shelley traveled by ocean liner from New York to Paris on business in May. Her expense for the 6-day cruise was $6,000. Shelley's deduction for the cruise cannot exceed $3,744 because 6 days times $624 is the daily limit. Meals and entertainment. If your expense for luxury water travel includes separately stated amounts for meals or entertainment, those amounts are subject to the 50% limit on meals and entertainment before you apply the daily limit. But if they're not separately stated, then you don't have to worry about trying to do any kind of proration. If your meal or entertainment charges are not separately stated or are not clearly identifiable, you do not have to allocate any portion of the total charge to meals or entertainment. I've never been on a luxury liner. I have a coworker here who loves them and goes on as many as they can. And I think that when you go on a luxury liner trip, at least what she's saying is you buy a package and all the food is all inclusive. You can eat as much as you want, as often as you want, all inclusive. And that's probably what this is getting at. If it's not separately stated, you don't have to worry about it. But it is possible that you could, I don't want to eat at the big dining hall. I want to go to the fancy restaurant where they've got the gourmet chef and have a nice dinner out for a particular meal. Well, in that situation, you would be able to clearly identify what that meal costs because it's not all part of the package. You'd have to pay extra for it. And to that extent that you did have to pay for that meal, you'd only be allowed to deduct half of it. And we'll get into the 50% limit on meals in a bit. There are some exceptions. The daily limit on luxury water travel does not apply to expenses you have to attend a convention, seminar, or a meeting on board a cruise ship. So we talked about the limits on luxury liner travel when you're using the luxury liner to get to a business destination. And that daily limit, though, doesn't apply if the ship is your business destination because you're essentially boarding that ship to attend the convention. And if you're boarding the ship to attend a convention, it's actually a lot more restrictive. For conventions, you can deduct your travel expenses when you attend a convention subject to the following rules. The convention agenda or program shows the purpose of the convention. The agenda is related to your position in such a way that it shows your attendance was for business purposes. You can show that your attendance benefits your trade or business. But you cannot deduct any costs of bringing your family with you, and if the convention is for investment, political, social, or other purposes unrelated to your trade or business, you can't deduct it at all. Conventions held outside of the North American area. You cannot deduct expenses for attending a convention, seminar, or similar meeting held outside of the North American area unless the meeting is directly related to your trade or business and it is reasonable to hold the meeting outside of the North American area. And there's a table that I have here out of publication 463, and it defines what the North American area is. And it includes pretty much quite a large area getting into Central America as well, but not South America. The North American area also includes U.S. islands, cays, and reefs that are possessions of the United States and not part of the 50 states or the District of Columbia. For example, you've got Micronesia here. That's nowhere near North America. It's way off, closer to Asia, but it's still considered to be part of North America for that purpose. Reasonableness test. The following factors are taken into account to determine if it was reasonable to hold the meeting outside of North America. The purpose of the meeting and the activities taking place at the meeting, the purpose and activities of the sponsoring organizations or groups, the homes of the activity members of the sponsoring organization and the places at which other meetings of the sponsoring organizations or groups would have been held, and other relevant facts that you may present. So in general, the rule is if you attend a conference on board a luxury liner, on board a cruise ship, it has to be a cruise ship in the waters of the United States and North America. But it's possible it would still be allowed even if it's not inside North America if you can present relevant facts that show it was still the only way you could attend and that you needed to attend. Cruise ships. You can deduct up to $2,000 per year of your expenses of attending conventions, seminars, or similar meetings held on cruise ships. All ships that sail are considered to be cruise ships. You can deduct these expenses only if the following requirements are met. The convention, seminar, or meeting is directly related to your trade or business. The cruise ship is a vessel registered in the United States. All of the cruise ship's ports of call are in the United States or in possessions of the United States. You can attach to your return a written statement signed by you that includes information about the total days of the trip, not including days of transportation to or from the cruise ship port, the number of hours each day that you devoted to scheduled business activities, and a program of the scheduled business activities of the meeting. You attach to your return a written statement signed by an officer of the organization or group that sponsored the meeting that includes a schedule of the business activities of each day of the meeting and the number of hours you attended the scheduled business activities. So that concludes the discussion of business travel, and you can see that in general, business travel is something that has some pretty specific rules attached to it. You have to establish that the trip is temporary, that it was for business. You have to keep records that establish the business purpose and show the business cost. And then on top of all of that, if you've got personal activities or side trips going on outside of that, you may have to explain those to the IRS and start reducing your travel expenses by formulas relating to travel outside of the United States. And then if you have business travel that involves travel by water, you've got a whole other list of rules you have to be concerned with as well. And we've been talking periodically throughout today's class about that 50% limit. If you've been in taxes for any length of time, of course you're aware of that. But we're going to get into the rules about deducting meals, entertainment as well. Unless you meet the rules for business entertainment, you cannot deduct the cost of meals unless it is necessary for you to stop for rest or to properly perform your duties. For your allowable meal expenses, you can use the actual cost of meals, or if you are traveling away from home, you can claim the cost of meals or a standard meal allowance. What is the standard meal allowance? Well, the standard meal allowance covers the cost of your daily meals as well as something called incidental expenses. Incidental expenses are expenses that you typically would incur while traveling away from home on business. They include things like costs of the fees and tips that you give to porters, baggage carriers, bellhops, hotel maids, stewards, or stewardesses, as well as transportation between places of lodging or business and places where meals are taken, if suitable meals could be obtained at the temporary duty site. So it's kind of a confusing sentence, so let's explain what it means. If you are staying at a hotel and there's a restaurant in that hotel, but you choose not to eat in that hotel until you catch a cab or a bus to another place where you eat, then the daily meal allowance would include that cost, that incidental cost. But if the hotel you're staying at or the place that you're staying at doesn't provide a meal that's suitable for you, and so you're forced essentially to eat somewhere else, then the cost of getting to that location where you do eat that other meal would be not included in the incidentals and could be claimed on top of the incidentals. So that's what that sentence is meaning. And then mailing costs associated with filing travel vouchers and payment of employer-sponsored charge card billings are also considered to be part of that incidental expense, and the incidental expense is part of the standard meal allowance expense. However, the incidental expense amount does not include any expenses you incur on business travel for things like laundry, cleaning, and pressing of your clothing, lodging taxes, or the cost of telegrams or telephone calls. Those are all going to be added costs that you can claim on top of your meal allowance. But all of these items in here are included within the meal allowance, and you could not claim these plus the meal allowance. You would claim the meal allowance and not claim anything additional for those amounts. Daily per diem rate. The daily per diem rate for meals that you are allowed to claim varies according to the city and the country that you are visiting. The rates are published by the U.S. government and updated at least annually. Travel within the United States is called CONUS, Continental United States. If you're traveling inside CONUS, the per diem rates are revised each year on October 1st, and for the last 3 months of the year, you can use either the per diem rate for the earlier part of the year or the per diem rate that is revised for the later part of the year. Now, since the recession started in 2008, and I am aware that we're coming out of it now, but since that recession started, I haven't really seen an increase in CONUS at all. The daily meal rates under CONUS, in fact, in some areas have dropped, but I haven't seen them go up for some time. But I would say as our economy is starting to recover, we're going to start to see the daily meal rates for certain cities start to rise again. For 2012, the standard rate for most areas of the country is $46 per day, and there was no change to that meal rate on October 1st of 2012, and I haven't seen a change in that rate for a few years, as I said. IRS Publication 1542 lists rates by region for high-cost areas within the continental United States. For example, higher rates of $51, $56, $59, $61, $66, or even $71 can apply to travel inside CONUS. And examples of higher special per diem rates for high-cost cities, I've put them in this table for you after looking them up. Los Angeles, Seattle, Las Vegas, Chicago, and Washington, D.C. are all $71 a day. Portland, Oregon, where I'm teaching this class from, Philadelphia, San Diego, or San Antonio are all $66 a day cities. Milwaukee, Wisconsin, and Salt Lake City, Utah are both $61 a day cities. Virginia Beach, Virginia, and Vancouver, Washington are examples of $56 a day cities. Other defined locations. The per diem rates for a city may also apply to the general region in which that city is located. For example, Phoenix and its suburbs qualify for the $71 daily meal rate, provided the area falls within Maricopa County. So Phoenix and Scottsdale, for example, are both inside Maricopa. But even if you weren't in Phoenix and Scottsdale, if you could at least show you were in Maricopa, then you would still be allowed that $71 a day rate. Per diem rates for travel outside of the continental United States. The standard meal allowance rates for CONUS do not apply to travel in Alaska, Hawaii, or any other location outside of the United States. The Department of Defense establishes per diem rates for Alaska, Hawaii, Puerto Rico, American Samoa, Guam, Midway, the Northern Mariana Islands, as well as a bunch of other areas where military bases are held. And then we also have daily per diem rates for travel to foreign countries, and these vary depending on the country you visit. And the per diem rates for foreign countries are established through the Department of State. So we've got a link up here for the defense travel per diem rates for areas outside of CONUS, but still considered to be part of the United States and its territories. And then if you travel internationally outside of CONUS or territories of the United States, then you go to the Department of State. And I have clickable links in the manual that you can use to access those sites, or you could just quite simply go to your URL search engine and type foreign per diem rates, and you'll probably get there in about 2 clicks. So the search engine will pull it right to the top, most likely. Now, examples of special per diem rates for travel outside of CONUS include Vancouver, Canada. Vancouver, Canada is a spendy place, $124 a day, but it doesn't touch London in the UK at $180 a day for food. Kuala Lumpur in Malaysia, you get $91 a day. Hong Kong is $139 a day. The island of Kauai in Hawaii is $105 a day, and Fairbanks, Alaska is $82 a day. All of those are substantially higher than the highest per diem rate you get inside of CONUS. There's a caution I should point out to you, and that is that when you're referencing IRS Publication 1542 or the U.S. government website, you will notice that both the lodging and the M&I rates, or the meals and incidental rates, are listed. The following rules apply when claiming per diem rates. An employee or a person who is self-employed filing a Schedule C or even an 1120S if you're the business owner can only use the meals and incidental rate. You cannot claim the lodging per diem rate. Even though you see it listed in there, that's off limits. That's not something that you're able to claim. So what is the lodging rate for? Well, it happens to be that if you are an employee, your employer can give you a daily lodging allowance. They can give you a daily lodging allowance up to the daily limit for your area. And you can use that lodging allowance to pay for lodging. And if you're able to get lodging for less than your allowance, you get to keep the difference, and it's essentially tax-free. And if your lodging costs more than the allowance, you'd have to out-of-pocket the difference, of course. So the lodging allowance per diem that you see there is not for use in preparing a Form 2106 or claiming employee business expenses. Only the per diem rate for meals and incidentals is allowed. Per diem rates for dates leaving or returning home. For travel days to and from home for a business trip, you must prorate your standard meal allowance, and you can do so by one of two methods. Under method number 1, you claim 3/4 of the standard allowance for the day you arrive and the day you come home. Method number 2, you can prorate using any method that you consistently apply that is in accordance with reasonable business practice. Let's talk about entertainment expense, because entertainment is similar to meal, but it is a different category. You can deduct ordinary and necessary entertainment expenses provided that they are directly related to business or associated with business. So what does directly related to business mean? To meet the directly related to test, all of the following must be true. You expect to derive income or some other specific business benefit other than goodwill at some future time. Although it is not necessary to demonstrate that you actually got the benefit, there had to be that purpose in the first place. 2, you actively engage in a business meeting, discussion, or other bona fide business transaction with the person being entertained. And your principal purpose of the combined business entertainment activity is the active conduct of business. It is not necessary to devote more time to business than to entertainment to meet this requirement. So you see I've got people here in a restaurant having a meal together. And the idea is that this is a business meeting. And because it's a business meeting, it would be allowed. Even though it's a meal, we wouldn't call it a meal. We'd actually call it an entertainment expense. And then we've got the big one here where we've got the stadium. You've got a football game. And when you're having a business discussion while you're entertaining your client, I put a golfer up here because I could see quite easily that business executives regularly would meet on the golf course and play a game of golf while they're having their business discussion. That's clearly something you could see happen. You could also see a business discussion clearly occurring over a meal in a restaurant. But could you really hold much of a business discussion in a stadium with 50,000 screaming fans? That's not practical. So could you claim the cost of entertainment that involves a football game? And the answer is yes. And that we call that an entertainment that is associated with business. If your activity does not meet the directly related test, it may still be deductible if it satisfies 2 conditions: that the activity has a clear business purpose, and that the entertainment directly precedes or follows a substantial bona fide business discussion, generally within a 24-hour period, however circumstances could allow otherwise. So let's just suppose you fly a prospective client into town, you pay all of their expenses, you have a meeting with them, you've paid their lodging, you've had a business lunch with them where you've discussed more business, and at the end of all, you surprise them with a ticket to the football game and you all go. That business discussion probably ended at the time you got to the football game. It wouldn't be practical to have a discussion there, but it's all part of wining and dining and entertaining this client, and therefore it would be allowed. There is a limit on meal and entertainment expenses. You are able to deduct only a portion of the amount you paid for allowable meal and entertainment expenses. In most cases, you will only be able to deduct 50% of your expense. However, certain transportation workers may be able to deduct 80% of their expense. The 50% limit on meal and entertainment, unless you are a transportation worker, your deduction for meal and entertainment expenses will be limited to 50% of your allowable expense. And this 50% limit applies whether you claim the standard meal allowance or actual expenses. It doesn't matter which you choose. So just up above, we showed that for high-cost areas inside the United States, it's $71 a day. The ultimate deduction you would be allowed is going to be half of $71 a day. So $71 a day probably seems like a pretty generous number, and it needs to be, because by the time you're done, you only get half of that. And $35 a day is probably close to what you might pay for a business day of travel if you're not entertaining people, depending on, of course, of where you travel. Caution, the 50% limit applies to entertainment and meal expenses only. Meal and entertainment expenses should be listed separately in any kind of profit and loss or list of expenses that you see, and they should never be lumped together with any other form of employee expense. And what I mean by that is it's very common for both bookkeepers and taxpayers to combine travel and meals and entertainment into a single category. And even if you look at QuickBooks, I think QuickBooks is a standard preloaded function or description lists travel and meals. And if you put expenses into this travel and meals category, now you've got a problem because it's lumped them together, and that's no good. You need to break them apart. So since the 50% limit applies to meals but not to travel, the method of allocating expenses for meals and travel into a single category is, quite frankly, inadequate. Either you need to multiply everything by 50%, or you do the opposite, which is multiply nothing by 50%. And the reality is you need to pull meals out of that travel, multiply the cost of meals by the 50% limit, and then claim that total. Now, the 50% limit does not apply for transportation workers who are under hours of service limits. You can deduct 80% of your business-related meal expenses if you incur the meal expenses while subject to Department of Transportation hours of service limits. These limits generally affect the following categories of workers: airline pilots and flight attendants, train conductors, and interstate truckers. In addition to being allowed to claim 80% of meal expenses, workers who are subject to hours of service limits are allowed to use higher daily rates than the $46 daily rate allowed for non-transportation workers. The higher rates are as follows. We have travel inside of the continental United States. The trucker rate, or the rate that you might use for an interstate transportation worker, is $59 a day rather than $46, and that is unchanged from 2011 to 12, and from 12 into 13 it's unchanged. Outside of the continental United States, you're allowed $65 a day instead of the $46 a day, but whichever one of these numbers you choose, you would multiply that by 80% to get the final deduction that that worker is allowed to have. I have a little bit of information in here about the Amtrak Act, and the Amtrak Act really has nothing to do with the federal return. It has to do with the state tax returns. And I thought I would put the information in here because when you're dealing with a transportation worker who's traveling away from home, odds are they're also a worker that falls under the Amtrak Act. And what the Amtrak Act does is it prevents states from taxing the wages of those transportation workers. The Amtrak Act essentially says that if you are a worker that, let's just say you're a long-haul truck driver, and your home state is California, and you run a regular route from California up I-5 along the Pacific coast to Vancouver, Canada, and back again, you're going to be spending a certain amount of each trip in California, a certain amount of the trip in Oregon, a certain amount in Washington, and then you're going to cross the border into Canada, and you're going to do a drop and then a return trip. And it used to be the case that states could and would try to tax the wages earned by those transportation workers for the period of time they were paid for driving through that state. And you can imagine that could be quite nightmarish, even figuring out what portion or number of hours you were in each state, or even having to track it and worry about it. And so what happened with the Amtrak Act is it's not necessary to track that. If you have a transportation worker that's crossing state lines, the states that they're traveling into are not allowed to tax their wages. But it has no real impact on the federal return. It only has an impact on preparing the state tax returns. We're going to get on with the next topic, which is business gifts. And business gifts are one of the more common expenses that my clients present to me, that they had to buy business gifts. And the rule on business gifts is quite a restrictive one, which means that many of the business gifts my clients give, they're going to lose out on the majority of the cost in terms of a deduction. So let's see why that's the case. There is this $25 limit, which is the problem. You can deduct up to $25 per year per client for the cost of gifts you give in the course of your trade or business. Gifts you give to a family member of a customer are considered to be a gift given to that customer. And you can read page 182 of Pub 17 where that particular rule is clarified. There are some exceptions to the $25 gift rule. The following items are not included in the $25 limit for business gifts. They include an item that has a cost of $4 or less and has your name clearly and permanently imprinted upon the gift and is one of a number of identical items that you widely distribute. Examples include pens, desk sets, and plastic cases. or the gift is a sign, display rack, or other promotional material to be used on the business premises of the recipient. In other words, I would call that a point of purchase display, and they can be quite expensive, but they're clearly advertising and hardly qualify as a gift. Still, they do have a value to them, and if you give that to your customer or a business associate, for example, if you own a 7-Eleven store, that could come into your premises from the beer company. They want you to have a point of purchase display for the beer company, and the beer company can give you that display. It could cost the beer company much more than $25, and they would still be allowed to claim it. Now, to clarify what I just said, I have a brief class exercise here. Let's read it, and I'll post up the pod that has the question in it, and as I'm reading it, you can see if you can grab the right answer. The question is, and you can see it spelled out here. Okay, so Jacob gave the following unreimbursed business gifts during the year. Mike, a business client, he gave a gift valued at $15, and then he also gave Mike's wife a $15 gift. Then he gave 4 staff members of a corporate buyer gifts totaling $100. And Janice, a business client, received a gift of $75. So the total cost of the gifts that Jacob gave was $205. The question is, what is the amount of gift expense deduction he is allowed to claim on his tax return, remembering the rules? I'll just give you a couple of minutes to select the correct answer. The correct answer is listed. Which one is it? Select the correct answer, which is answer number B. And I actually, in the manual here, have that answer sideways in a box written for you. It is $150 is the correct answer. How do we arrive at that? Well, we look at Mike and his wife as a combined unit. The cost of that gift for them combined is $30, but the gift deduction will be limited to $25. We then have the 4 staff members. They're allowed $25 each, so $100 is going to be allowed in full. And then Janice, a business client, we gave a gift of $75, but the gift deduction will be limited to $25, which means we have 25 plus 100 plus 25 is 150. Now, what some people get confused by is they think, well, because the gift was over the gift amount, I can't deduct anything for it at all. And that's not the case. You are allowed to deduct up to $25, but anything over $25 you cannot deduct. Next topic is work-related education expenses. You may be able to claim work-related education expenses as an adjustment to income, or you may be able to claim them as an education credit, or you might be able to claim them on Schedule A. And in some cases, you might be able to do all 3 of those, and you're left with deciding which one to do. And the IRS says that you obviously cannot claim more than one benefit for the same expense. But more than that, if you want to claim your education expenses on Schedule A, the rules are very restrictive. You have to pass a bunch of different tests. I have been in an IRS audit where the education topic came up. I had a client, he was a salesperson. He was taking a master's in marketing class at school, at university. He was paying quite a bit of money for it, something like $20,000 a year to be in this master's program. And he was deducting costs related to that master's program for 2 or 3 years, and his number came up. He got audited. The reason I decided to put the master's program education expenses on Schedule A was that he would then be able to claim bigger deductions at the state level. We could go for the lifetime learning credit at the federal level, but if we did that, he wasn't going to get much on Oregon. So we thought, well, I'm going to stick him on Schedule A because I really do think that the Masters of Marketing would just fit in with his role as a salesperson. I don't think it's going to qualify him for a new profession or anything along those lines. And we ran around this rabbit with the IRS auditor for a long period of time. And in the end, the auditor said, oh, well, if he had claimed the credit, his tax would have been the same, so you don't have to prove anything to me. But until we got to that point, the auditor was very much leaning against allowing the expense and even made claims like, well, you can't claim education expenses if they're going to qualify you for a degree. And so then I opened up the IRS publication on education expenses where it said, you can claim these expenses even if they will qualify you for a degree. So I turned that around and stuck it in her face, and she went humph and then started making other demands. Among those demands was a letter from the employer saying that the employer was requiring it or felt that it would benefit the job, and that the employer had a policy of not reimbursing it. It was a lot of gobbledygook stuff on the side that was going to be very much an irritant to have to present to her, but in the end we never had to go that far because she determined that the credit would have given him as much as the deduction. And so we won on that count, mainly because we didn't have to defend it past that point. The reason I describe it is because when you are trying to claim education expenses on Schedule A, if your client is audited, they're going to be scrutinizing that pretty closely, and they're going to be challenging it in any way that they can. So let's learn the rules and make sure we're on top of them. So to be deductible on Schedule A, your educational expense must be required by your employer to keep your present salary, status, or job, or serve a bona fide business purpose, or maintain or improve skills needed in your present line of work. My argument was a master's in marketing would serve a salesman very well and was obviously clearly related to his current line of work, and when he was done, he was still going to be a salesman, and I don't know what a master's of marketing would get you other than sales. So to me, it seemed to be all in line, but it still was closely looked at. Even if these tests are met, you cannot claim a deduction for education expenses if they are needed to meet the minimum educational requirements of your present trade or business, or they are part of a program of study that can qualify you for a new profession. Now, an illustration of what's meant by that is something that has been in the IRS publications for a long time, and it's an example of an attorney. He is an attorney, and he paid educational costs to study accounting because he wanted to become a tax attorney and specialize in that type of law. And at the end of it all, he studied enough and did enough work that he became a CPA. Well, the IRS disallowed all of the education expenses because they qualified him for a new profession of being a CPA, even though it wasn't his intention to practice as a CPA, it was his intention to practice as an attorney. So you do have to be aware of the fact that if they do qualify for another position as a result of the education, it's automatically not going to qualify. And another example would be perhaps when you first decided to get into taxes. If you are a CPA, you probably took some tax while you were in university and maybe learned some more tax during your apprenticeship period. But lots of people enter the tax profession by taking H&R Block's tax school or taking a basic tax course like the one Pacific Northwest Tax School offers, and don't have a real big expensive endeavor getting there. But whether the expense is small or large, well, the question is, are you learning a skill that's going to lead you to a new profession, or are you leading to a skill that's going to augment your current profession? Now, obviously, if you're a CPA and you go and study tax, it would be easily argued that that is not a new profession. It's part of an accepted practice for CPAs. But if you are not a CPA and you just decide you want to learn to be a tax preparer and enter the world as a tax preparer, then that cost would be entering a new profession and it would not be deductible on Schedule A. Education expenses that can be claimed in more than one way, again, you have to choose which is best, and you're allowed to choose whichever method is legally allowable that is best for you. Now, if you decide that you're going to claim the expenses on Schedule A, what deductions can you actually claim? Well, you can claim deductions for the following expenses: tuition, books, supplies, lab fees, and similar items; certain transportation and travel costs, the cost of getting to and from school, for example. Your daily travel from home to school or from the office to school, that can be allowed. Other educational expenses such as research costs, typing costs, etc. And in the area of transportation costs, what I talked about getting in your car and getting to school, if you are going to school on a temporary basis that is 1 year or less, you can deduct the cost of traveling from work to school and from school to home. If you are going to school for more than a year, however, you can deduct the cost of going directly from work to school only. You should claim your unreimbursed educational expenses as you do other unreimbursed employee business expenses. Generally, that means you should claim the expenses on Form 2106. However, Form 2106 is not required if you were not reimbursed for any of your expense by your employer and you are not claiming travel, transportation, or meal expenses as a part of the education cost. If you are not required to file Form 2106, you would simply figure your education cost and enter it directly on Schedule A on line 21. And here is an example where Form 2106 would not be required. You paid $6,000 for tuition and another college fees related to your current occupation. You are not claiming an auto expense, and your employer did not reimburse any of your expense. You are not required to file Form 2106. Therefore, you can report the entire education expense just as a direct line entry on line 21 of Schedule A. Now, there are some special rules for teachers. Remember, we just talked about the fact that the amount that you're paying for going to school cannot qualify you for a new profession, and if it does, you can't deduct it. That attorney who became a CPA couldn't claim it. Teachers are different. They get special treatment. If you are a teacher, the following rules apply. Once you are considered a teacher under the rules for your state, additional education required by the state to keep your job shall be considered qualifying education. And once you have met the minimum education requirements for your state, you are considered to have met the minimum educational requirements for any other state you go to work in at a later time. All teaching and related duties are considered to be the same general kind of work. A change in duties in any of the following ways is not considered to be a new business. An elementary school teacher to secondary school teacher, teacher of one subject to teacher of another subject, classroom teacher to guidance counselor, and classroom teacher to school administrator. Claiming educator expenses. If your educator expenses, when combined with other allowable miscellaneous deductions, total less than 2% of your AGI, you should claim your educator expenses up to $250 as an adjustment to income on 1040 instead of on Schedule A. But you can claim the classroom supplies that are allowed under the educator expenses up to $250 on the front page of your 1040, and then anything above and beyond that could also be claimed on Schedule A. Depreciation on computers. The IRS does allow depreciation deductions for computers, but they have some pretty strict rules about when they are allowable. You can claim a depreciation deduction for a computer that you use in your work as an employee if it is for the convenience of your employer and it is required as a condition of your employment. For convenience of the employer, it means the use of your computer is a substantial purpose of using the computer, and it is required by your employer. You need to have it. And if you have a computer that's not required by your employer merely because it aids you in your work, for example, another computer at home or a laptop that you use at home to perform job duties, but it's not required by your employer, then depreciation on that computer is not allowed. And here is an example of a computer not required for the employer's convenience. You are an engineer at an engineering firm, and you occasionally take work home at night rather than working late at the office. You own and use a computer that is similar to the one that you use at the office to complete your work at home. Since your use of the computer is not for the convenience of your employer and is not required as a condition of your employment, you cannot claim a depreciation deduction for it. And then there's information in here about how to depreciate computers. You can read that on your own. I'm going to get very heavily in depreciation next week in a course I have called Depreciation Made Easy. And given the short time we have today, I'll leave that for you to read or come back for Depreciation Made Easy, which, by the way, is my favorite course. I love depreciation. Work clothes and uniforms. You can deduct the cost of upkeep of work clothes if the following two requirements are met. You must wear them as a condition of your employment, and the clothes are not suitable for everyday wear. Examples of workers who may be able to deduct the cost and upkeep of work clothes include people like delivery workers, firefighters, healthcare workers, law enforcement officers, letter carriers, professional athletes, transportation workers, and musicians and entertainers. However, musicians and entertainers can deduct the cost of theatrical clothing and accessories only that are not suitable for everyday wear. Protective clothing. You can deduct the cost of protective clothing required in your work, such as safety shoes or boots, safety glasses, hard hats, and work gloves. Examples of workers who may be required to wear safety items include carpenters, cement workers, chemical workers, electricians, fishing boat crew members, machinists, oil field workers, pipe fitters, steam fitters, and truck drivers. So what kind of clothing then does not qualify? Well, clothing that is suitable for taking the place of regular clothing does not qualify as a business expense. And it is not enough that you wear distinctive clothing, nor is it enough that you do not, in fact, wear your work clothes while you're away from work. For example, I'm wearing this business suit here because I look good on camera, right? It's definitely more money and less comfortable to purchase this business suit than it is for other clothing. And the only reason I've purchased it is for work. But that doesn't make it allowable because this clothing is suitable to wear away from work. It's therefore not allowed as a business deduction. And therefore, you can think of the most expensive business suit out there that a business executive could possibly buy to make themselves look good and move up the corporate ladder. It's not going to be allowed. So examples or other examples of clothing that also are not deductible include things like a painter is required by his union to wear a white cap, white shirt, or white jacket, white bib overalls, and standard work shoes. This clothing is not distinctive in character, and it is not a uniform. Or blue work clothes worn by a welder at the request of a foreman, also not allowed. And a big one I get all the time from servers in restaurants, waiters and waitresses is, well, I have to have black pants, a white shirt, I have to have those things. And it's like, well, that's very nice, but they're not deductible.
Bay of Islands, B-A-Y-O-F-I-S-L-A-N-D-S. Bay of Islands.
Military uniforms, well, they clearly are a uniform. What's up with that? You generally cannot deduct the cost of uniforms for military if you are on full-time active duty in the armed forces. However, you may be able to deduct the cost of military uniforms in the following situations. If you are an armed forces reservist, you can deduct the unreimbursed cost of your uniform if military regulations restrict you from wearing it except while on duty as a reservist. In figuring the deduction, you must reduce the cost by any non-taxable allowance that you receive for those expenses. Fatigue uniforms. If military rules do not allow you to wear fatigues when you are off duty, you can deduct the amount by which the cost of buying and keeping up these uniforms is more than the uniform allowance you receive. Student in an armed forces academy. You cannot deduct the cost of your uniforms if they replace regular clothing. However, you can deduct the cost of insignia, shoulder boards, and related items. And finally, if you are civilian faculty or staff member at a military school, you can deduct the cost of your uniforms if you are a civilian faculty or staff member. Job search expenses. So you're unemployed, you're looking for work, or maybe you're in your current line of work and you're looking for a better work. You can deduct certain expenses you have for looking for a new job in your present occupation. So when we look at the education expense and whether or not you can deduct that on Schedule A, it's only allowable if it does not qualify you for a new profession. You can apply that same rule to jobs expense. You are only allowed to claim the cost of looking for a job in your current line of work. If you're looking for a new career in a new line of work, those job search expenses are not deductible to you. So you cannot deduct expenses if you're looking for a job in a new occupation, or there was a substantial break between the end of your last job and the time you're now looking for a new one. I would say, for example, you're a mom and maybe you took 10 years away from the workforce. You were a nurse before you took time off. You took 10 years off to help raise your children, and now that they're in school, you're saying, hey, I would like to go back into nursing, and so you start incurring some job hunt expenses. IRS says no, even though you're still in the same line of work. And finally, if you're entering the workforce for the first time or looking for a job in that field for the first time, that's not deductible either. Employment and outplacement agency fees. If you pay an employment agency to find you a job, that is deductible as long as it's in your present line of work. If your employer later pays you back, obviously you have to reduce your deduction by any amount that you are reimbursed. And if the employer pays the employment agency directly, you do not have to include that cost in your income. For resumes, you can deduct amounts you spend for preparing or mailing copies of a resume to a prospective employer if you are looking for a new job in your present occupation. And if your job search expenses involve travel and transportation costs, those are allowed so long as the job search itself is allowed. Home office expense. Well, home office expense is, quite frankly, something I deal with a lot, but really only for self-employed individuals. Because if you are an employee, the ability to claim a home office expense, it just fizzles away. There's very few people who can ever benefit from it. One of the reasons for that is if you own the home that you wish to claim a home office deduction for and you have a mortgage on your home, well, the interest that you pay on that mortgage is already deductible. So how does claiming a home office even begin to help you in that situation? Only in very minor ways by the cost of, say, utilities and the tiny amount of depreciation you'll get on the home, and maybe a little bit for repairs. It just doesn't add up to enough to really even matter. Above and beyond that, odds are it's not allowed in the first place. So let's look at the rules for claiming home office expense on Schedule A. To claim a home office expense, you must have a part of your home that is set aside for regular and exclusive business use, and you must maintain your home office for the convenience of your employer and not just as a convenience for yourself. Test to claim the home office. To claim a home office, the office must be the principal place of business for your trade or business, or a place you meet or deal with your patients, clients, or customers in the normal course of your trade or business, or it must be a separate structure not attached to your home. But even if you meet these three tests, if the office is for your convenience and not your employer's, it won't be allowed at all. If you are allowed to claim home office expense, you would figure your expenses, but you do not attach Form 8829 to your return. 8829 is a form that attaches to a tax return where you are filing a Schedule C or Schedule F. It does not attach to your return if you are claiming home office because you are an employee. The tax software we use, Drake Software, offers a worksheet that for all intensive purposes works the same as Form 8829. However, you do not mail it in with the return. The IRS does not want 8829 attached to a return where you're claiming home office on Schedule A. Rather, instead, you figure your home office deduction, whatever it is, and enter it on the Schedule A, but you do not attach Form 8829. But you could fill out the 8829 or a worksheet that is the equivalent of 8829 to figure the amount of your deduction, and then you would keep it in your records. Reporting employee business expenses is the next topic. We've been talking about all of the different deductions that are out there and whether or not you're allowed to claim them. But now we're at a point where we're going to talk about how do we actually claim them on the tax return. And the way that you claim employee business expenses on your tax return is either as a direct entry on line 21 of Schedule A or by reporting them first on Form 2106 and then carrying them to line 21. So when is Form 2106 required? Well, it's required if you had expenses for auto, meals, entertainment, or travel, or your employer reimbursed you for some or all of your expenses. If you do not have any of the 4 kinds of business expenses I described, or your employer did not reimburse your expenses, then you don't need to have the form filled out. You don't need to attach it to your return. Even so, whether the form is required or not, anytime you are ever involved in an audit for one of your clients' returns, the IRS auditor is going to be all over this concept of accountable versus non-accountable plan. What is each and what's the difference? Well, a non-accountable plan is a plan where your employer gives you an allowance or no allowance at all. They basically give you your pay. They might give you a little bit of extra pay in a form of allowance, but you do not report any of your expenses to your employer. You're totally responsible yourself for determining your expenses and claiming them on your return. An accountable plan is a situation where your employer tells you to collect your expenses, pay your expenses, and then submit the receipts and they will reimburse you. Or they give you an allowance, but they still expect you to report in the reimbursements and to report in your expenses. And to the extent that your expenses are covered under that allowance, the allowance is tax-free. Most of the time when allowance is given, and it's given the name allowance, it means that it's going to be included in the taxable income. If, say, the employer is going to give you a car allowance of $200 a month, odds are they've bumped that up on your W-2 and it's included as income. But if they say we're going to reimburse your mileage rate, 30 cents a mile, submit to us your mileage records at the end of each month and we'll reimburse you for that, that means you're under an accountable plan. And because you're under an accountable plan and you're receiving reimbursements in from your employer, that type of reimbursement is going to go on the 2106 and it has to be accounted for there. So we have a non-accountable plan where your employer gives you an allowance and that allowance is included in box 1, wages of your W-2. And in that situation, you don't report any expenses to your employer and you include all of your expenses on Form 2106 as if you hadn't been reimbursed. Then we have the accountable plan, which is exactly the opposite. And under an accountable plan, you don't need to report any expenses on Form 2106 at all because your employer reimbursed you for everything. But you can end up in some situations where the expenses are more than the reimbursements. And if that's the case, then you still would fill out Form 2106. So let's look at these distinctions here. This is a table that comes from Pub 17 on page 191. It talks about when you have an accountable plan and what happens under an accountable plan. If you are reimbursed under an accountable plan with the actual expense reimbursement and adequate accounting is made and any excess money that your employer gives you is then returned to your employer, then nothing is reported on the W-2 and nothing is reported on 2106. If you are under an actual expense reimbursement with adequate accounting and return of excess is both required, but it's actually not returned. So under the accountable plan, you should return $50 to your employer, but you didn't do it, you kept it. Then that excess $50 amount is going to be reported on your W-2 as box 1 income. At least it should be, and you still wouldn't file Form 2106. If you're under a per diem or mileage allowance up to the federal rate, and you make adequate accounting to your employer and any excess amount your employer might have given you is returned, then your employer reports nothing on your W-2 and you report nothing on 2106 unless your expenses exceeded the amount your employer reimbursed you. And if your expenses exceeded what your employer reimbursed you, then you'd fill out 2106 to figure the amount that you get to deduct. For per diem or mileage rate up to the federal rate, if adequate accounting and return of excess is required but excess is not returned, then the excess amount is reported on box 1 of the W-2 and you don't file Form 2106. You have no deductible expenses. In fact, your expenses were less than the reimbursements, therefore the excess reimbursements get grossed up on your W-2. Per diem or mileage allowance exceeds the federal rate. Adequate accounting up to the federal rate and excess is not returned. Well, let's just suppose right now we've got a federal rate in place for 2012 on mileage of 55.5 cents a mile, but your employer gives you $1 a mile. That would clearly be in excess of the federal rate, and to the extent that you've been paid more than the federal rate, your employer has to gross up your W-2. And in that situation, unless you can show you had other expenses, you're not going to be filing Form 2106. You have a non-accountable plan with either adequate accounting or return of excess or both, but not required by the plan. Then whatever allowance you are given is going to be fully reportable in Box 1 of your W-2, and you're going to fill out 2106 and claim all of the expenses you had. And finally, a non-accountable plan with no reporting of expenses. Again, the entire amount is reported in your W-2, and then you would turn around and claim all expenses. So that's kind of a lot to absorb, so I created an illustration to combine some of these concepts and help clarify them. The character in this illustration is named Sally Smith, and she is a union representative. Her employer gave her a $200 monthly auto allowance, and then on top of that reimbursed her 14 cents per mile. During the year, Sally drove 14,000 business miles, 2,500 commute miles, and a total of 20,000 miles. Her round-trip daily commute was 10 miles. Sally also spent $500 on deductible entertainment expenses. Her employer reimbursed her $250 for those entertainment expenses. Since Sally is given an allowance, she is reimbursed. Since she's given an allowance and she is reimbursed at the same time, she is on both an accountable and a non-accountable plan at the same time, and as follows. The $200 allowance is paid regardless of the number of miles she drives. She is not required to refund the excess. It's hers no matter what. The allowance is provided under a non-accountable plan, therefore it is taxable to her. The 14 cents per mile reimbursement is paid only when Sally submits receipts on a monthly expense report. The reimbursements are provided under an accountable plan. Report Sally's reimbursements on Form 2106 as shown next. And I have her 2106 here on the screen in front of you. On line 1, we enter her auto expense. She had 14,000 business miles. The mileage allowance for that is 55.5 cents per mile. You multiply that out and you get $7,770. She also enters the $500 of entertainment expense she had on line 5. And then on line 6, she carries down the total. And that's her actual employee expenses. That's what she paid for her business. We then move down to line 7 and look at how much her employer reimbursed her. Well, her employer reimbursed her 14 cents a mile, and that means that she received $1,960 of reimbursement for mileage. Her employer also reimbursed her $250 for meals. So we're going to do some simple math. Line 6 minus line 7 means that we have $5,810 of unreimbursed auto expense, and we have $250 of unreimbursed entertainment expense. We carry those numbers down to line 9, but in the case of the meal expense, we have to multiply meals by the 50% limit. So the allowable meal expense deduction will be reduced to $125. $125 plus $5,810 is $5,935, and that is the amount that we will be able to claim for Sally Smith as a deduction on line 21 of Schedule A. Moving over to page 2 of Form 2106, page 2 asks for you to provide information about the vehicle being driven. And this is a little pet peeve of mine because I so often look at tax returns that new clients bring into me where the tax preparer from the earlier year did not fill this information out. It's mandatory, it's required, and so the preparer, by leaving it off, was either negligent or incompetent. There's no flattering way to come about it any other way. The information is required, and although it's not frequently brought up as an omission unless you get into an audit where the auditor starts raising their eyebrows, it's still a technical detail that I think top-notch preparers should always be taking the time to interview their client, answer these questions, and select the boxes. So in the case of Sally Smith, we've entered the date placed in service for the vehicle, the number of miles driven, the number of miles that were business miles. We arrive at the total percentage of the miles driven that were for business. We've entered the round-trip daily commute, the total commute miles, and the amount of commute miles is a part of personal miles. All of the other miles driven is 3,500 miles. So 35 plus 25 plus 14 equals 20. Moving over to statutory employees. Statutory employees are a special category of worker who do not report their expenses on 2106. Instead, they report their expenses on Schedule C. And if you have an employee who has a W-2 and the statutory employee box is checked on that W-2, it means that that worker is a statutory employee and the expenses can be claimed on Schedule C rather than 2106. The beauty of that is they don't have to itemize their deductions, they're not subject to a 2% limit, and ultimately whatever amount of expense they have reduces the amount of wage income they report on line 7. So if they had a W-2 for $100,000 and the statutory employee box is checked and their employee expenses totaled $20,000, you would actually fill out Schedule C, figure the expenses on Schedule C, and then put $80,000 on line 7 as wage income. You would not make any entry at all on line 12 for self-employment income, nor would you assess self-employment tax. The types of workers who could have the statutory employee box checked include certain agent and commission drivers, full-time life insurance sales representatives, certain home workers performing work according to specifications furnished by a person or organization for which the services are performed, and certain traveling or city salespersons working full-time except for sideline sales activities for one firm or person soliciting orders from customers. So essentially, there is a certain amount of direction and control over these workers, but for tax purposes, they're still considered to be self-employed in how they control their work activities, but under other laws, they meet the provisions for being statutory employees. And if they are a statutory employee, then the employer will withhold Social Security and Medicare tax, and the employer can also, with the agreement of the employee, hold out income tax, but they don't really receive any other employee benefits like health insurance, for example. Obviously, if you have self-employed business expenses, those go on Schedule C. And if you are a performing artist, a starving performing artist, who worked for 2 or more employers during the year, and each of those employers paid you at least $200, and your expenses for being a performer and an artist exceeded 10% of your income, and your AGI is not more than $16,000, then instead of itemizing your deductions, you can claim them as an above-the-line deduction as an adjustment to income on the front page of 1040. I've yet to have an artist that met that criteria because it's so restrictive. Also, a note here on ministers. If you are a minister who received a tax-free housing allowance, you must reduce your deduction for employee business expenses by the percentage of your income that is not taxed because it was used for housing. So if you're a minister and your regular wage is $30,000, but you're also receiving a tax-free housing allowance of $10,000, it means that your overall income is $40,000. And if you incur $5,000 of employee business expenses, you're only going to be able to deduct 75% of the $5,000 because only 75% of your income is being taxed. And there's a worksheet that you can fill out to figure that. Also, if you're an armed forces reservist and you traveled away from home more than 100 miles overnight, the travel costs you have for traveling away from home overnight more than 100 miles from home are an above-the-line deduction. And if you are claiming that type of expense, you would fill out Form 2106 to figure the travel expense, and whatever amount of travel expense you can show the reservist paid is due to travel away from home overnight more than 100 miles, you would carry that to the front page of 1040 and enter it as an adjustment to income. And any other unreimbursed expenses would carry to line 21 of Schedule A. I have a good illustration of this particular formula and how it works in my course called Adjustments to Income. But other than that location, I'm not going to talk about it more here today because I already did a good illustration in an earlier course. Now, I have a summary table here of the different types of employee expenses and how you would go about claiming them on Schedule A. But just due to the time restrictions we have, I'm going to leave that to you to read on your own. And I'm going to move over quickly to talk about a few other final concepts. And I can see that we're at 1:55. If any of my attendees today need to leave at the top of the hour, exactly at 2 o'clock Pacific time, I'm going to put up a password at that time, and you can write it down, leave the meeting, and go take your password test. And those of you who want to stay a little bit longer, because I'm not going to finish by 2, I do have a little bit more to say, you can stay and listen to the rest of the lecture if that's what you'd like to do. And the next topic we're going to talk about is record keeping. I've mentioned that I've been in a few audits with a number of different clients over various employee business expense related items, as well as some small business owners who've been audited on their Schedule Cs. And I cannot emphasize proper record keeping enough. If your client cannot prove an expense the auditor is going to throw it out. And what degree of record keeping is required? Well, you'd be surprised to learn. I've been in a meeting. I was actually in an IRS audit where my client was living entirely off investment income. She wasn't receiving any alimony, but she has a good portfolio that she accumulated before her divorce. It's enough to live on comfortably. And she is also a little bit neurotic. She shreds every single piece of paper that she ever gets. So she didn't save any receipts for her health insurance. Well, you might go, well, who would need to save a receipt for health insurance? I mean, it seems to be enough that if I can get a receipt from the health insurance company showing that I paid my health insurance bill in full, that would be enough. But the IRS auditor that we were in the meeting with said, I need a canceled check. I need to know that someone else didn't pay that health insurance for you. I need to know it came out of your bank account. And I said to the auditor, we all have health insurance fairies out there paying our $10,000 or $15,000 annual health insurance bill for us, don't we? I was ready to strangle her because it was such a preposterous position she was taking. And yet she would not budge. My client was able to present a bill from the health insurance company, confirmation of payment that the payment had been made and how much had been made during the year, but because my client had shredded her checks, that auditor was arguing with me. It was just unbelievable. So if you can take a situation as preposterous as that and say, okay, well, the IRS auditor was arguing over something like that, think of what they can argue about on other things which are much less easy to prove you had an expense for. I think health insurance is probably pretty easy to get a receipt on, but other types of items, there's no going back and finding receipts after you've thrown them out. That's much harder. So, and what I'm essentially saying is that a receipt isn't even enough. You have to prove, in addition to the receipt, which proves a payment for an expense was made, you also have to be able to prove that you're the one that made the expense or made that payment. So you must keep accurate records to prove that you paid expenses. You cannot deduct amounts that you approximate or estimate. The IRS prefers you keep written records to document your expenses. A computer record is considered to be a written record, and the IRS will also consider oral testimony. However, the greatest weight is given to the written records. Now, of course, if we had gone to appeal on that particular client with the health insurance, I think we would have won. But the fact that we even had to have the discussion is what's so irritating. And who wants to have to go to appeal? So it's just best to really give your clients good advice from the beginning and make sure that they're doing accurate record keeping. So I've got in front of you now a table that comes from IRS Publication 463, page 27. And it does a really good job of summarizing the level of record keeping the IRS expects. If you have expenses for travel, the IRS wants you to be able to document the amount of travel for each separate element of expense for that travel, including the cost of the travel itself, the lodging, the meals, any incidentals. It wants you to be able to separately account for those items. One time when I was with a client being audited, the auditor wanted to see a receipt from the hotel. In this case, it was Motel 6, proving that no part of the bill from Motel 6 was for food. And I leaned across the desk at the auditor and I said, Motel 6 doesn't have a restaurant. Motel 6 doesn't serve food. So it seems kind of silly to be asking my client to prove to you that no part of their hotel receipt was for food. But nonetheless, that is one of the things to look at. Because, of course, if you stay at a nicer hotel, 3-, 4-, 5-star hotel, you could order room service. You could go to the restaurant in that hotel and have your room billed for that food. And so when it comes time to claim your expense for travel, the lodging receipt may also include meals in it, and you have to break those out. With regards to travel, the IRS wants to know the dates you left and returned from each trip. It wants to know where you went and what the business purpose of that trip was. With entertainment, it wants to know each separate expense relating to entertainment, including taxis, etc., the date of the entertainment, the name and address and location of the place of the entertainment, the business purpose of the entertainment, and the relationship of the people being entertained. In other words, who were they? And that same rule goes for gifts. It wants to know the purpose of the gift, the relationship of the person to whom you gave that gift. And with transportation, the IRS wants to know the cost of each separate expense. And for a car, that would essentially mean your mileage log, as well as any receipts if you're claiming the actual expenses. It wants to know the date, and that would be part of your mileage log, the business destination, which should be a part of your mileage log, and so on. All right, and then we move on to some important record-keeping tips. And these are not so much from me to you as they are for me to suggest that you give to your clients, because these are ideas that many clients haven't thought of but would be very helpful to them. The tips I give them are, if you are claiming business expenses, you will need to keep receipts. It is wise to charge your gas and other business receipts to a different credit card than you used for business expenses. That way it is easier to track and separate business expenses from the personal expenses. Keep an envelope in your car where you can store your receipts, and as you require them, as soon as possible, file your receipts in an organized manner. Because remember, lost receipts equal lost deductions. And if your client loses $100 of receipts, then they've probably just thrown out another $25 in tax they could have saved but can't. You should maintain your business records for a minimum of 3 to 7 years from the date you file your return. And lots of people think, well, these receipts are a couple of years old. Do I really need to save them? Yes, you do. For at least 3 years after the date you file the return, right? And if you file late, the IRS can come along and audit you substantially after that. And finally, a canceled check, bank statement, or credit card statement is not considered to be adequate evidence of an expense. It should be accompanied by a receipt or other documentation, and the flip side of it is all you have is the receipt. The IRS could say that's not enough. It wants proof of the payment. So ideally, you'll have both the canceled check or the credit card statement, plus you will have the receipt. You should keep both. So classwork assignment involves preparation of a Schedule A in a Form 2106 for a character named Edward Scissorhands. He is single, and he lives at the address shown here in Paramount, California. He did not pay any mortgage interest or real estate taxes during the year. Edward was naughty and did not have any state taxes withheld by his employer. His AGI is $30,000. He also owns a 2005 Dodge Caravan, which he uses for his work as a landscaped artist. He first began to use the vehicle for business back in 2007, and Edward claimed the standard mileage allowance last year. This year, Edward drove the van 30,000 miles, of which 5,000 were commute, and 13,000 were personal miles, and 12,000 were business miles. He had the following expenses: gas, oil, and maintenance, $4,400; new tires, $320; repairs, $1,500; AAA membership fee of $65, car washes of $60, insurance $800, tolls and parking for business $145, and lease payments of $6,000. And the inclusion amount for those lease payments is already factored into the number I've given you. And if you want to know what an inclusion amount is, we cover that in Depreciation Made Easy, but not here today. In Part A of this problem, we would like you to figure Edward's deductible auto expenses using both the standard mileage rate and his actual expenses. And when you've done that, is he better off claiming the actual expenses or the standard mileage rate? In Part B, during the year, Edward flew to King County, Washington. His per diem was $71 a day, and he attended an advanced gardening class. He was there full days and had the following expenses: tuition and supplies, $1,500, airfare, $300, meals, $150, hotels, $400, and taxi was $100. And we would like you to prepare Form 2106 and Schedule A for Edward. And with regards to the auto expenses, use whichever method in Part A gave you the larger deduction. And so if you're a self-paced student, at this point you should just push pause on the video, go ahead and prepare the tax return for Edward. That is his Schedule A and his 2106. And when you are ready, resume playback, and I'll show you the answer key.
Please pause the lecture video and complete this session's classwork. Enter your answers into the LMS when you have finished. Then resume the lecture for the classwork review.
So firstly, we have a paragraphical description of the reasoning that we've put into Edward's tax return. We're looking at the facts and putting those to numbers on forms. Edward put 30,000 miles on his van during the year, and the business miles were 12,000. So the first thing we have to do is figure his business use. His business use is 12,000 divided by 30,000, or 40%. If he claims a standard mileage allowance, he's going to go 12,000 business miles times 55.5 cents per mile, and he'll come up with a business auto expense of $6,660. Let's compare that with figuring the actual expenses. And under the actual expenses, we look at all of the costs normally associated with maintaining the vehicle. Lease, insurance, car wash, AAA membership is a form of insurance for the car, repairs, new tires, gas, and oil. When we total all of that up, we get $13,145. But we still have to multiply that by the business use percentage. And when we do that, we get 52.58. And clearly 66.60 is a higher number, so he's better off with that. The next part is to prepare his schedule, or his Form 2106. And on Form 2106, we enter his auto expense, which in this case is the standard mileage amount. And then we also enter any other expenses he had for parking fees, tolls, and transportation. And in the wording of the problem, we provided you with some additional costs that are not a part of his standard mileage allowance. And you'll just have to look in the manual for what those were. Here we are. We have line 2 was parking and tolls, $145. And line 3 are other travel expenses, which we equated as being taxi $100, $300 for airfare, and $400 for hotels. So we have parking and tolls, $145 on line 2. We have all of the costs of the travel to Seattle of $800. And then we have the cost of the education at that convention itself, or that training seminar, which was $1,500. And finally, we told you that his cost of meals while he was in Seattle was $150. His per diem rate for Seattle would have been 71 times 2, but that's less than $150, so we go with the $150. He can do that. And we ultimately end up with $9,105 of business expense, $150 of meal. We have to apply the 50% limit to the meal. We add $75 to $9,105, and we have a deduction of $9,180. And on page 2 of the Form 2106, we have to answer all of the questions related to business use of the vehicle, including the deduction that we calculated using the standard mileage rate of $66.60, and we have done that. And then on the Schedule A, the only expense he had was these employee business expenses of $9,180. We have to subtract 2% of his adjusted gross income. $600 from $9,180 gives us an allowable deduction of $8,580. So that completes the review.
To complete this session, number 1, take the password test in the LMS. Number 2, complete the homework assignment and enter your answers into the LMS. And 3, complete the quiz and enter your answers into the LMS.
Tiberius, T-I-B-E-R-I-U-S, Tiberius.